Hello and welcome to ET India Inc. Boardroom. My name is Suresh Venkat. I will be your host for today's sessions. Now, businesses, both large and tiny, took a beating this last year, but were inventive in navigating their way back to growth. Over the course of this week, we gathered into the ET India Inc. Boardroom where over 50 leaders, economists, policymakers, and business people shared their expectations for India Inc. in the year ahead. Across each of the sectors, we had stories of resilience and lessons from the playbook of steering business for growth. Join us as we turn our attention to banking, digital payments, markets, and financial services. Our lineup of speakers includes bankers and heads of financial institutions who will help us make sense amidst all the noise. ET India Inc. Boardroom is brought to you in partnership with Transaction Next, powered by NPCI. Those of you who missed earlier sessions, you can log on to etboardroom.com to catch up on the frontline insights from thought leaders. But for now, let me introduce our first session, a special address by the Chairman of the State Bank of India.
Very good morning, my dear friends. The Narasimhan Committee had recommended way back in 1992 that the banking sector be organized in a way that it consists of a few banks which are large enough to be internationally competitive and meet all international standards. The committee suggested that merger might have been one of the tools to arrive at this. The consolidation of the PSBs in the last financial year seems, in hindsight, an offshoot of this recommendation. With the recent consolidation of the PSBs, the government has achieved the larger goal of achieving large and well-capitalized banks with international and diverse geographical presence as envisaged by the Narasimhan Committee. Government desires that large-sized public sector banks, which are functionally strong, professionally managed, and can meet the demands of growing aspirational India. To this, if we consider the announcement of the privatizing few public sector banks, which were not part of the consolidation process, then we are heading for a situation where government will have reduced share of PSBs in the overall banking system. This is the best way to strike a balance between innovation, efficiency, competitiveness. We also expect that the health of the PSBs in general will improve as the size of the bank brings with it the scale of economies which entail lower costs of capital and funds, better geographical diversification, and overall financial stability. Globally, banks entered the pandemic with a large amount of capital and high liquidity buffers and have shown resilience so far. And unprecedented policy support has helped to maintain the flow of credit to the household and firms. However, profitability challenges in the low interest rate environment call into question banks' ability or willingness to continue to lend in coming quarters. Bank may be concerned about rising credit exposure and increasing non-performing loans once policy support measures end, especially where the recovery may be delayed or incomplete. Banks may also face challenges in generating return above the cost of equity amid continued compression of net interest margins, a development long evident in Japan and Europe. Reflecting unprecedented policy support, spreads have recovered almost entirely, even in the sub-investment grade sector. Interestingly, there is now a consensus that banking sector NPAs will not rise significantly, reflecting in part the stricter borrower discipline that the RBI and banks have assiduously brought about in the last couple of years. However, it may be noted that in India, the stressed assets were declining just prior to COVID-19 outbreak. However, with the regulatory forbearance, the true picture is still not reflected in the accounts. Based on footnote on SBI quarterly 3 results, the difference in GNPA is on account of the Honorable Supreme Court judgment is almost to the extent of 67 basis point. Budget has announced creation of bad bank or ARC-AMC structure for purchase of stress assets from banks, which is a big positive. Further normalization of IBC is also on cards. Also, RBI allowed the option to directly invest in defaulted corporate bonds to FPIs, who could earlier only get exemption through investment through the security receipts and debt instruments issued by asset reconstruction companies and debt instrument issued by an entity under the corporate insolvency resolution process. These exemptions are the short-term limit and minimum residual maturity requirement under the medium term framework for investment by FPIs and corporate bonds. This will widen the market and will provide a faster exit route for the bondholders. RBI on the payment system notes that the decade of 2010-20 can be termed as the decade of payment in India. There have been many defining moments that transformed the payment ecosystem of the country and attracted international recognition. During the decade, the country has witnessed the introduction of innovative payment system, entry of non-bank players, and a gradual shift in the customer behavior from cash to digital payments. We have a unique, secure, and interoperable unified payment interface for retail payments, biometric based as well as QR code based payments. The shift in payment preference in the last 10 years is evidenced by the fact that the volume of paper clearing, which comprised of 60% of the total retail payment in the financial year 2010-11, has shrunk to 3% in the financial year 2019-20. This striking shift in payment preference has been due to the creation of robust electronic payment systems such as RTGS, NEFT, and ECS that has facilitated seamless real-time or near real-time fund transfers. In addition, this decade has witnessed introduction of innovative payment systems that provide instant credit to the beneficiary. With the launch of fast payment systems such as IMPS and UPI that are available to consumers round the clock for undertaking fund transfers, and introduction of mobile-based payment systems such as Bharat Bill Payment System (PPIs) to facilitate payment of bill and purchase of goods and services, and National Electronic Toll Collection (NETC) to facilitate electronic toll payment. Data shows that low-value payments dominate the volume and the turnover, and products that afford real-time instantaneous transfer are the most preferred modes of payment. The facilitation of non-bank fintech firms in the payment ecosystem and PPI issuers, BBPOUs, and third-party application providers in the UPI platform have furthered the adoption of digital payments in the country. Payment systems have always been regarded as a public good and an ancillary activity of banks, which can be leveraged as a base to provide various other services. We should not forget that NPCI was an initiative of the banking industry, and SBI was also one of the core promoters. Thus, the above developments augur very well for the banks. This because, as direct providers of payment services, banks have not been left out, and today the latest technology is available with banks. Further, our collaboration with the fintech has created better customer experience and newer business opportunities. Perspective of banking sector, the COVID-19 pandemic has created many long-term opportunities. On the opportunity side, the new vistas of financial intermediation, leveraging on technology and new business models are rapidly emerging in India. API connectivity allows financial institutions to be agile, that is, to innovate and integrate new services faster while providing lower costs for their customers. By opening up to a more flexible infrastructure and simplifying the terminal software market, speed and time to market delivery have improved. Fintechs and banks in India have made considerable strides in adopting and promoting digital banking since the outbreak of COVID-19 pandemic. As the contactless services are in demand and digital mode is becoming the most preferred option among banks, a recent report of S&P note that India's digital disruption poses a relatively low risk to the long-standing position of its top-tier bank. Many banks in India have been quick to embrace new technologies to cater to a vast and growing young tech-savvy customer base. Both commercial banking and retail banking are poised for a major transformation as technology will enhance the user experience and speed. In retail banking, world over and India, banks are collaborating with fintechs to offer point-of-sales financing. The options to extend unsecured loans, both pre-approved and sanctioned on tap, are being explored. The blockchain technology offers a promising method to speed up KYC process. AI and ML tools are being tested to address customer issues and ensure seamless onboarding. In commercial banking, banks will have to hit the reset button on business practices. As the economic consequences of a global shutdown unfolds, companies' desire to preserve liquidity will be one of the defining features of the marketplace in 2021 and beyond. Before the pandemic, corporate strategy was driven in large part by the quest for operational efficiency. After COVID 19, operational risk will play a bigger role in corporate planning. Real time cash management, end to end supply chain, and vendor financing using digital platforms are being recognized as key to operational efficiency and containing risk. Blockchain is being deployed to de risk and speed up the trade finance business. Recently, announced national blockchain policy will further accelerate the drift in this direction. The Union Budget 2021-22 has been majorly focused on capital expenditure. The centre is expected to undertake rupees 5.4 lakh crore of capital expenditure, mostly in core infrastructure such as road, urban transport and railways. Further, the budget has allocated around 2 lakh crore for urban local bodies for capital expenditure at state level. Thus, we are expecting around 7 lakh crore of spending of capital goods. Agriculture infrastructure has also got fair attention in continuation with past policy. Hence, from industry point of view, we can expect good demand in core sectors such as steel, cement and fertilizer sector. The expenditure allocation in health is also positive for the sector. The business is expected in tier 2 and tier 3 towns where the demand is high and there are supply constraints. Also, renewable sector will have good traction, particularly in compressed biogas, solar and biofuel segments.
Next, we turn our attention to PSU banks and look at how PSU banks, amid divestments and mergers, can play an integral role in Atmanirbhar Bharat.
Thank you, dear panel members, for joining this panel. Today, the topic of the conversation will be the role of public sector banks in the growth of new Atmanirbhar Bharat. So with that, very quickly, we have today Mr. Sanjeev Chadha, MD and CEO of Bank of Baroda. We have Mr. Mallikarjun Rao, MD and CEO of Punjab National Bank, and we have Mr. Ramachandran, ED of Indian Bank. So moving on to the topic very quickly, I think we have seen COVID happening. We have seen how public sector banks has really gone through ups and downs after NCLT, and now with post-COVID and all the packages, the entire focus on credit has been towards MSME and retail. So first, I would like to ask Mr. Chadha sir, what is your view in terms of the growth from here on? Means public sector banks had historically been very focused on the corporate credits. But now, do you really see that changing a lot, things moving more towards MSME and retail for public sector banks?
So I think the corporate emphasis is not going to go away entirely, particularly when we talk in terms of the revival of the economy, in terms of Atmanirbhar Bharat. The opportunities on the corporate are going to increase. And as a general proposition, about 50% of the books of public sector banks tend to be corporate. So while there will be a secular trend in terms of the growth of retail, corporate will remain a large part of the business. And I think going forward, given the fact there's consolidation that we have seen in the public sector space, it should have a salutary impact in terms of the kind of pricing power which is there, in terms of getting the risk pricing right, which should help margins on risk mitigated basis. Having said that, there is no doubt that the structure of the economy is changing and retail is going to become a larger and larger piece as we go forward. And if we have to write the India story, we must again have the capabilities of delivering retail, but not only delivering retail, but delivering it through channels which the current consumer is comfortable with. So I think part of the solution will therefore lie in making sure that we use this opportunity that COVID gave us by telescoping change, by making sure that all of us become used to digital ways of doing business, that how can we enable our retail distribution through digital channels, use analytics to analyze the large amount of data that we hold, and also make sure that the delivery is as smooth as possible. I think if we can do both these things, make sure that you do good quality corporate growth, make sure that you price your risk well, and also transit into retail, because that is really what is going to be holding up the future. You will have a much better balanced growth and also growth which possibly is on par with the market.
No, absolutely, sir. I think retail is, and it's been a great growth wave for many of the private banks and also more specifically for NBFC. Mr. Rao, how do you see for PNB Bank, again, historically corporate credit, but not only retail, but even MSME, which is becoming a key piece here, right? And especially with the Atmanirbhar story and self-reliant India, MSME is going to play a key role. How do you see public sector banks really working with this particular segment?
No, there's no doubt about the commitment of public sector banks. If you look at even for PNB as well, our corporate book is not more than 50%. Retail MSME definitely play a critical role, but for a bank of our size like Bank of Baroda or SBI or PNB, it is the universal banking. We can say that one focus area we will have, and even the economy requires what you call funding in every sector. If you are talking about corporate, then infrastructure is very important. Recently, Honorable Finance Minister has declared a lot of measures in terms of improving the infrastructure investment. They have also brought about development financial institution a different dimension to cater to the requirement of infra lending. Since sole dependency on commercial banks may not be appropriate, as asset liability matches also will be different. So coming back to economy to be propelled in a greater growth as anticipated by everybody, it could be 21, 22, could be anything around 11 to 12%. If that kind of a growth is required, there is a scope for investment not only in corporate infrastructure, but also in retail, MSME, and otherwise. The demand which has been subdued in retail and MSME during the period of pandemic is seen to come up as a pent-up demand in the onset of festive season from October onwards. And now the demand is also holding good, though there are little variations in each sector, but there is no doubt about the demand coming up in 21-22. So the only one area where we have to see is, in spite of government coming out with tax reforms effective from 1st of October 2019, we have not seen much of an investment as of now, the reason being pandemic. Now we expect investment also in industry and services sector to come up. Thereby the opportunities for funding will be there. Recently, RBI declared that the credit growth for commercial banks was at 6.7% in the first week of January. And I am sure by March 21, it could reach up to 8%. So 21-22, if the GDP is growing at 11%, the credit growth could be anything around 12% or 15%. We'll have to wait and see how the demand is going up. But there's no doubt about the demand being visible and a lot of activity taking place in economy during 21-22.
No, absolutely, sir. Credit growth, and I think even the latest corporate results really show an upswing and an uptrend. I think the results have been really good for corporate India, and that augurs well for the banking sector. But one of the other changes and trends we definitely see is how digital is really picking up. Mr. Chadha, sir, you referred to digital, right? And how that is going to play a very crucial role in how most of the banks are going to service its customers or even acquire its customers. Coming back to Mr. Chadha, sir, you picked up digital and did mention about it. Any specific things you really see how public sector banks are looking at digital, the kind of investments the banks would typically make in this particular area?
So I think the banks actually had started making investments sometime back, BOB in particular. So investments in terms of, again, creating a data lake, all those were made in the last few years. Now I think the time has come to tie all these pieces together to make a coherent value proposition for the customers. So on the asset side, as of now, we are executing a very comprehensive digital lending project, which would encompass retail, all pieces, unsecured personal loans, home loans, car loans, also MSMEs loans going forward, particularly the lower ticket ones. I think we have to understand that the lower ticket size loans are part of, you might say, the landscape. While large ticket loans will be there will be demand for low ticket loans. But if you have to do these profitably, they can only be done if they are digitally intermediated. So more and more of these loans are going to migrate to digital channels, and that's something that we are already preparing for and executing. So we would expect that as part of this project, over the next 1.5 years, almost all our retail loan underwriting would migrate to digital channels. This will bring down costs substantially. B, in terms of delivery, since a lot of this is going to be straight through processing, the delivery is going to be much better. We have seen again that a large part of this market, the small ticket market, had actually migrated to NBFCs over the last few years. Now, in some ways, we have come to an inflection point where both NBFCs and banks have to work together to address this market. Banks will do it directly also through digital lending platforms, and they could also do it through co-lending mechanisms. The Reserve Bank of India has recently revised its co-lending policy, which has meant it becomes far more feasible to do co-lending with MSMEs and for personal loans. But if this needs to be done at scale, it can only be done through the intermediation of technology. So digital is going to be absolutely fundamental to risk management, and also through doing loans directly, and also acting in concert with other market players so that we can deliver these loans to the last mile consumer.
No, absolutely. I think working together and working out this entire co-lending and alliance model with NBFCs is absolutely a great point, sir. So coming, Mr. Ramchandran, sir, I would like to invite you over here. How do you see the banks really, is the co-lending model really working out? Is technology the only way these problems will get resolved? Do you see any kind of hindrances coming up? Because new NBFCs, and especially the new age NBFCs, the way they are capturing some of this market, it really makes sense of both the systems really coming together, which is really going to help the economy better.
Yeah, definitely. I agree with Mr. Chadha that without technology, co-lending will be extremely difficult, because of the amount of monitoring which we need to do on these small ticket loans, which is raised by the NBFCs. And we need to maintain about 70 to 80% of the loan book on our side, and 10 to 20% will be with the NBFCs. So there is a need for an effective way of managing the things and we cannot load the core banking also on this, because it is an effort where the documentation will be joined and the accounting also will be joined. The amount which is recovered has to be apportioned accordingly to the NBFCs as well as the banks. And therefore, there is a need for a very strong technology backbone, which will enable us to monitor this effectively, and also in order to increase the scale of operations in co-lending. And that's the reason why we have not seen that when it came with the co-origination model and the co-lending model, we didn't see much of traction happening in this space, primarily because we need to set up that base where we will be in a position to quickly take up the loan details from the NBFCs, and also be in a position to apportion the credits when they are received by the NBFCs. I think maybe in about a year's time, I think this technology also will mature. But on the other side, when you look at technology as a base, we have the analytics on one side, and the other one, there are certain enablers which have come in, which will enable us to look at small ticket loans purely in a digital manner, right from the point of application till the disbursement, which is going to be the game changer going forward, where the NESL has come out with the digital document execution, where the e-stamping as well as the signing of documents is digital. And then banks can do the due diligence in a completely digital manner. So without having the physical person present, we can get an image of the digital image of that person as to his credit worthiness, as to his credit history. And then going forward, I think that is going to be the way forward, where people can apply for loan and also get the disbursement without having to visit a physical branch. And that I think the technology is mature, and now I think public sector banks also will be taking that leap now.
Absolutely, and you can clearly see a trend of a lot of public sector banks already taking steps there. Mr. Rao, you have a housing finance company, you're a large bank. How do you see this really playing, especially from public sector banks? Typically their returns you have seen has been quite on the lower side as compared to many private players, and especially NBFCs. And that's been a big challenge. Do you see this being a good answer for bringing profitability at a very good level in public sector banks, both the entire MSME retail story as well as the technology part?
See, if you look at housing finance companies, while the disadvantage with them is interest rate, but the advantage is last mile connect with the customer and early turnaround time. That is quick turnaround time. These are the two factors whereupon they are able to compete with the public sector space, even in housing finance. So housing finance companies across the country had little amount of stress in terms of the investment in real estate, which they have done. That is the reason why probably we have seen not only PNB Housing Finance, many of the housing finance companies, but then that has been passed. They have come out of that problem. There is a good piece available for them to do the business in housing finance, in spite of the fact that their interest rates are a little higher than that. But that piece is available. Now, this additional advantage for them is they can tie up with various banks for the co-lending, though they cannot do with PNB because we are the parent there, but they can do with various other banks in terms of co-lending. That is one additional option for them. The hybrid rate can still be much better for the customer, though it will be little higher than what public sector offers, but it will definitely be lower than what the housing finance companies give. So the kind of impetus what we have seen currently after a pandemic in the housing finance as well. So I'm expecting that housing finance companies also will do well in the days to come, while public sector will have its own area with respect to increasing the housing loans.
But sir, on the point on increasing returns for public sector banks, how do you see really an MSME play and technology play? As you put it, a good part, and Mr. Chadha also mentioned, still a good part of the balance sheet will be corporate credit. But the returns on the lending side, which and NBFCs have seen, has been more on the retail side. Of course, banks have really been the great support for building the entire infrastructure story and even for corporate credit. So how do you see that playing out from a profitability perspective for public sector banks?
See, if you look at in the last almost a year, on the onset of pandemic, the RBI has reduced the repo rate by 115 basis points. So it has impacted both the sides, liabilities as well as assets. The savings rates also have come down, term deposit rates also have come down, lending rates also have come down. More or less, repo linkage is given to all retail and MSME advances. And corporate also, as you know, the pressure is always there for offering at a lower price. And in the recent times, because of high liquidity available, we had to give at a very, very low rate, even linked with GSEP price or treasury bills. So nevertheless, if you have observed the results declared in many of the public sector banks, the NIM was not impacted very badly. If you have seen the NIM, even in our bank, when we declared recently, it was 3.09. So holding on to the NIM between 2.75 to 3.25 in the range of in that range, I'm not seeing as a challenge. But what we require is, in the process, we need to enhance the efficiency to drive towards digitalization, so that you can hold on to the NIMs more effectively by reducing the service cost. So as Mr. Chadha rightly said, in terms of personal loans particularly, where end-to-end digitalization is possible without any manual intervention, there you can lend more in the number. Critical mass may not be very high, but service cost will be very lower, because it can be delivered immediately to the customer and only collections have to happen over a period of time, and majority of the customers are data is available with the bank. So most of the banks are doing that. Even public sector space is also in that direction. So it is a balancing the entire portfolio in terms of how we are using our service cost for delivery, and that kind of balancing the portfolio will give us advantage for retaining the NIMs and earn. This kind of a situation is going to remain. You can't expect to charge a higher loan interest rates, because the market is like that, unless the repo rate moves up, which we do not expect at this point of time. So the current NIMs between 2.75 to 3.25 appear to be healthy if we are able to maintain consistently.
Absolutely. And in fact, you're right. So the cost of delivery really gets managed with getting technology in. But the other big element also, which had been a bit of a problem child for public sector banks, was the high NPA levels. And in fact, the latest financial stability report does indicate that potentially the gross NPAs may go up because of the pandemic impact, and especially MSME or retail sector may get impacted. Mr. Chadha, there again, any thoughts, any views? The corporate results has been great. Do we really see the NPAs going up because of the pandemic impact, or it should be okay for corporate India?
So I think as far as corporate lending is concerned, even if we look at what was the scenario before COVID came, we had seen 3 or 4 years of high stress, and whoever was left standing post those 3-4 years had reasonable resilience, which is why we have seen that even on account of COVID, the impact has been less as compared to what was anticipated, simply because corporates have built a very high degree of resilience. Now, along with that, the recovery has been much sharper as compared to how any of us had anticipated. So that's number 2. Number 3, I think the regulators have made available the means to mitigate whatever stress that might have come about even after this. So there was the restructuring option which was made available, and to the extent it was necessary, it has been used. But the fact again that the restructuring has come down at a far lower level as compared to what we again anticipated at the beginning would seem to suggest that as compared to the previous prognosis, corporate stress has been less. So going ahead also, I would believe that particularly when it comes to large corporates, we should see a very significant improvement going ahead and a reduction in credit costs. I think this is pretty much borne by our experience over the last 12 months and also the corporate results that we have been seeing.
And Mr. Ramachandran, your views, especially on the credit cost coming towards MSME and retail. I think you also have gone through a large merger as well.
Primarily, no. As far as Indian Bank was concerned, it was very low on the corporate lending. There was not much of this thing for the last maybe 4 or 5 years. But then with the amalgamation of Allahabad Bank and getting a pan-India presence, and there are a lot of corporates which have come in from the Allahabad Bank side also into Indian Bank. And Indian Bank had traditionally in the southern part of the country, a few of the major corporates over there. Now the focus is now trying to shift towards corporate lending also. There is an impetus given to see that the corporate lending is also improved. And with some of the support coming in from the government side and in terms of infrastructure creation, in terms of roads, HAMs, solar, these are, we find that it's more into some 3 or 4 pockets where this lending is happening, which we wanted to be more broad-based, primarily into capacity expansion and in terms of other enterprises coming up. But on the MSME and the retail side, we have been growing healthily, and it's about 11% growth year on year on the MSME. And the NPA is also fairly contained. It's just about 8 to 9%. And I think with the pandemic also coming down, we find that we feel that it will definitely revive. And the support which has come from the government also has helped us in terms of GECLS, that CGSSD and all that. So we have been aggressive on that front to support the corporate, support the MSMEs. Retail has been slightly muted, I would say, in terms of when compared to the industry level. But we are now trying to find out how we can step up, because there was a process change which we brought about after the amalgamation. So that has to get roots, and then that will also pave the way for increased retail lending, which will support the pricing part of it, to protect the NIM. And some of the new products, like we have given a focus on the startups, where we've tied up with IIT Madras and now with the Indian Institute of Science, Bangalore. So we are trying to see that we are able to grow in that area as well, so that we will be in a position to protect our lending to the MSMEs, as well as the balance is about 54% on the retail and MSME and 46% on the corporate book.
No, great, sir. In fact, it's really heartening to know that, probably the confidence is there that NPA levels will be under control for across corporate credit as well as for MSMEs and retail as well. But the recent budget has also, the government has come up with this entire concept of bad bank. Mr. Rao, what do you think about the entire concept of bad bank, number one? And number two, do you think it should help solve the entire, NPA issues which public sector bank had, and was a big growth impediment, right? They were really challenges to growth because of the NPAs. Do you think a bad bank will really help that?
The announcement by the Government of India by the Honorable Finance Minister regarding ARC AMC is a welcome decision. In fact, this issue has been in the discussion in public domain for quite some time. Even at IBA level, we had discussed and we have recommended to RBI as well as Government of India. There's no doubt about its utility. There are quite a few operational issues currently when other ARCs are taking the assets through bidding, because many of the banks, more than 4 or 5 banks will be in the consortium lending when they are funded to an asset. In order to ARC to take that asset under a transparent process of bidding, all the banks have to go for bidding, then only it can happen. So there is an operational issue, number one. Number two, there has been an accumulation of NPA over a period of time. It's even more than 6 trillion to 7 trillion currently across the banking industry, where we definitely need a one-time measure to hive off that and go for a proper way of disposing that through transparent process. As we have seen in the last 3-4 years, when IBC has come, more than 4 trillion has been resolved in terms of debt, even though the extraction is around 45 to 46%. The fundamental point is the market has matured, whereupon there are parties, there are avenues for the people to purchase the ongoing asset, whether for continuation of the same by additional lending or even liquidation process. So some element of maturity has come, as a result of which we expect that many of these assets can be sold in a transparent process through bidding. If that has to be a hazard, there is a requirement of aggregation of this debt from various members of the consortium. And once it is aggregated, the process will be smooth. It was in this context that we had also recommended on behalf of IBA to RBI and Government of India. That is the reason why Honorable Finance Minister has declared that. I see that in next few days' time, the modalities will be finalized. I don't have any doubt with respect to its utility. Very shortly, between 6 to 12 months' time, this ARC AMC concept should get maturity in terms of aggregation of assets, because when we transfer, it will be only an aggregation at net book value. Only ultimately through the bidding process from ARC, it will be purchased by the vertical party. This will give good amount of balance sheet cleaning for the public sector, and you have a visibility with respect to requirement of capital adequacy with the profile available at our bank. So it is a good move. I'm sure it will do wonders in the days to come, particularly for the accumulation of roughly around 6 to 7 billion NPA profile currently we are carrying.
Well, that should help public sector banks' balance sheet also get much more lighter and easier in terms of its flexibility to operate and give further corporate credit. Mr. Chadda, with this entire concept of the AMC coming in on the bad bank side, you've seen post the NCLT a lot of stressed asset funds have really shown great interest in acquiring some of the situations. Do you think this bad bank situation is going to be a great news for some of the stressed asset funds, or even for the other corporate India to do great acquisitions and good turnaround stories really coming out of this?
So I would believe yes. I think, as Mr. Rao mentioned, the primary benefit of this particular initiative is the aggregation of NPAs. Now, anybody who wanted to acquire a controlling interest, I think that was the biggest challenge. How do you make sure that A, the process is speedy? Two, how do you make sure that all the different stakeholders, they can act in tandem? I think the fact that this particular device should ensure aggregation and make sure that whoever is the counterparty, whether it is a stressed asset fund or anybody else, I think if they are able to speak to one entity and make sure that decision making is fast, it can have a tremendous impact in not only unlocking value for banks themselves, but also if you look at again the amount of capital that is stuck, the amount of assets which are as of now yielding suboptimal returns, it can actually have a very, very salutary impact going forward. Also, I think in terms of overall improving the quality of the investment climate, it should be a big help, because you are sure that look, decisions will always go wrong. Entrepreneurs are in the business of taking risk, but the fact is it should be possible both for banks as well as for entrepreneurs to unwind their position in an expeditious manner. And I think this is one instrument that should be able to improve the climate overall and have a big impact going forward.
Absolutely, sir. And probably, sir, two words you used, unlocking value. And I think that's really important, because if you actually today see the market capitalization and the valuation which is given by the market public sector banks is typically less than 1x of price to book. And with all those initiatives, Mr. Ramachandran, sir, what's your view? Do you see with the credit growth coming back, NPA situations getting resolved, retail MSME getting back to focus, and technology helping reduce cost, where do you see market's perception on the value of public sector banks?
No, definitely. I think the bad bank concept, no, it's strong on intent, but little on details, I would say, because we don't know the capital structure, what is the type of organization which is going to head it. Because we have experimented the ARC model, and we need to see that we are able to hive off these bad debts, like Mr. Rao was telling, so that we can unlock the capital and give it for productive use when the economy is rebounding, so that the banks are not constrained for lending. And also it will help in the resurrecting the economy, as well as also improving the credit portfolio of the banks. It should not be just the transfer of bad assets to another bad bank, but it should be that we are improving the appraisal skills, and then there the digital will come into play, where it will be completely a methodology which will be used, where we will be more transparent and we will be in a position to assess the balance sheet or the other criteria of the organizations which are coming in, which will going forward. Now we're learning the lessons for the last 4-5 years, which will help us to bring in a credit discipline, as well as also build a healthy book, and that would in turn propel the value of the public sector banks in the minds of some of the QIPs and the issues which are coming to the market also we have seen favorable results. That itself shows that the market is open for investment in public sector, and with the bad assets removed, I think definitely it will help us to unlock the value, definitely.
Oh, great, sir. Mr. Rao, what's your view there again with two banks, in addition to IDBI Bank really coming up on the divestment theme? How do you really see public sector banks trying to improve the market's perception on this particular segment, right? At least in my view, it definitely needs an upgrade. But what's your view, sir?
No, and see, if you have seen in the recent times, there has been a good amount of interest in the market towards the public sector space. See, whatever has happened over a period of time ever since the asset quality review came, which was an offshoot of lending in infrastructure, happened during the year 2007 to 2012. Majority of the reasons for external factors, either in road segment or steel segment, while that has been a past, banks have done extremely well during the year 1920 and 2021 in terms of showing profits in the public sector space. So this has brought back some element of confidence in the market, which can be seen by the fact that many of the public sector banks have gone to the market either for AT1 bonds, Tier 2 bonds, or QIP, and some of the banks are lined up in that activity. Probably they are looking for good amount of value in the years to come for the public sector space, maybe 1 year, 2 years horizon. The other important factor is now, because of post-pandemic anticipation of growth in GDP, and also the finance minister's declaration with respect to investment in infrastructure, the role of banks is going to be more clearly defined in the days to come in terms of lending. So these are all the avenues which appear and which show good amount of improvement in the balance sheets of the banks as well as their performance in the days to come. So there is a positive sentiment towards the public sector space. Now, in terms of government reducing the stake or privatizing, it is just a matter of what you call important thing. If you look at Narasimhan Committee way back in 91-92 itself has recommended to have only few banks in the public sector space or in a larger what you call gamut of size, and some of them at the regional level, which was reiterated again by the PG Naik Committee recommendations. So even though it has taken longer duration of time, probably because of policy consistency or even the ecosystem to be conducive, whatever may be the reason, but it is a welcome decision by Government of India, first of all, to reduce their stake as much as possible in the bank's public sector space so that good amount of retail PC is available in the market. If I want to give an example of PNB, we had 85.5 stake from Government of India, which was reduced to 76.9 now. And in the recent times, we have seen large amount of volume being traded in the market, which is a very important thing. When the trading becomes high, the reflection of the price also will be there, commensurate with the performance of the bank. So I see that there will be good movement in the next year in terms of the interest towards the public sector space in the market.
No, absolutely, sir. I think it's long due now, especially with the performance and the results you actually see of many of the public sector banks. Mr. Chadha, sir, one question to you. I think you've seen the merger of banks and especially Bank of Baroda. You also recently announced that the merger is complete now. And with the divestment program happening in, any tips, we don't know which are the two banks which are going to get divested, but any particular tips you would like to leave to public sector banks or to the market in terms of what are the 2-3 core things which people need to see when you're really looking at divestments for the banks?
So I think now this is a question which, again, very frankly, I'm not comfortable to answer. But again, when it comes to amalgamation, I think there are a few things that which are lessons for us. I think any change is a great opportunity to do things which may not have been possible earlier. I think amalgamation was one opportunity which was there, and BOB and I'm sure the public sector banks have capitalized on it completely to make sure that even while we amalgamate the banks, we also set them for the future. And I think COVID also has been a similar kind of opportunity where it has opened up horizons, telescope change, and make sure that the banks actually have an idea in terms of what is the world going forward. So I think it's important for us that we make the investments and we reposition our banks post-amalgamation, post-COVID for the future. And the sanitary impact, again, is something which is on account of two reasons. With the amalgamation, the number of public sector banks has come down. So rather than, again, having 10, 12, 15 Me Too kind of institutions where differentiation is not possible, now it will be possible for us to make sure that the value proposition that public sector banks present, that can be clearly brought out and presented to the investors. Two, it also gives us an opportunity, again, to make sure that post-privatization, when again the numbers come down, the banks which are there, they can become larger, more credible, and much more vibrant entities which can help shape the future. I don't believe there's going to be a time when public sector banks are not going to be an important part of the landscape because they fulfill a very large and important requirement, on the side of corporate lending, which they continue to dominate, B, in terms of financial inclusion. But going ahead, if we can marry that relevance of being large corporate lenders and being bankers to every Indian, along with positioning ourselves as agile players who can contribute as much to the digital space, I think there's a role of public sector banks going ahead in the future, which is as important as it was in the past.
Well, thank you, sir. I think you superbly summarized. In fact, I was going to ask you, sir, any final comments from your side, and you actually made a nice summarized way of comments. Mr. Rao, any final comments from your side?
See, a very simple revival of economy is the objective of every stakeholder in the country, and banks have a very important role. And out of the public sector banks have very, very critical role to play in the year to come. So we all are gearing up for the improvement in the economy, and we'll be seeing the opportunity to come forward.
Mr. Ramachandran, your final comments.
It's primarily now one is that the consolidation. The second one, the consolidation helped us to bring about process changes. And the third one is now we are on the cusp of the digital wave. And since we have consolidated, it's a high time that we can take this wave right as it is, so that we will be in a position to position public sector banks also as nimble participants in the market space, which will help us going forward in the next decade. The last decade was the core banking, and this decade will be the digital space.
So thank you, sir. Thank you, everyone, each one of you, for providing your comments. I think it was a great discussion. I think it's clearly public sector banks are going to play a very important role. And now with the focus on few banks and the differentiation you can really create, I think you all are there on the verge of really going through a very, very strong growth journey. So, sir, thank you very much, and thank you for your time.
Thank you.
Thank you, Jay. Yeah, thank you.
The BSE Sensex has been all over the news in the last few weeks. The index has been hitting lifetime highs and creating unprecedented wealth for investors. Our next session is on the Indian broking industry. Let's find out more from our speaker.
Thank you. It's a pleasure being here. I think the broking industry is going through very rapid changes. COVID has accelerated the changes in many, many ways, and probably brought their own changes which we had not expected before. Whenever I look at the broking industry today, it reminds me of Charles Dickens' book, The Tale of Two Cities. It was the best of times and it was worst of times. So I think in some ways we are going through both. We are going through the best times for broking industry, and we are probably going through also the worst of times in many, many ways. In terms of the best of times, I think all of us know during COVID time, India has done wonderfully well. It has had very little infection vis-a-vis what happened to the rest of the world. It also has less number of deaths per million vis-a-vis rest of the world. So I think India has done wonderfully well. It has also become a vaccine capital of the world. It has also handled its financial system well, and also it has handled the back office for the rest of the world. So I think overall, this is a time of reckoning for India. But if you look at the Indian broking system or broking industry, it has also seen tremendous growth. In last 1 year alone, BSE has seen more than 29% increase in the number of accounts it has. BSE now has 6.15 crore accounts. And if you look at the unique PAN numbers, it's around 3.8 crore, that is 38 million unique PAN numbers, which are available with us in our system. This is pretty much the largest, including all mutual funds, any exchange in the country, any depository. We are pretty much double the size of any nearest competition in terms of the number of investors registered with us. And that is, I think, very heartening. Why this has happened is people have come from all over India to register themselves on the broking platforms. And because of the COVID lockdown and other things, they've started interacting with the broking systems. They've started trading on them. And so now we have pretty much grown by 29% in one single year. I mean, it took us 145 years to reach 4.5 crore or 45 million accounts. And in 1 year, we have gone to more than 6.15 crore or 61.5 million accounts. So that's a heartening story in many, many ways. And I think the trend will accelerate in terms of the number of people touched by the BSE and Sensex and everything put together. I estimate somewhere close to 30 to 35 crore people, including our own 3.8 crore PAN number, unique PAN number, plus the people who are indirectly investing into the stock market using the EPFO's ETF framework. Put together, we are directly touching probably 7-8 crore. And if each house has 5 people each, we are somewhere between 30 to 35 crore people being touched. Many times there has been complaint and even a perception has been created that Indian markets support very few lakh investors. In fact, last week also during budget discussion, one of the important anchors of a general sort of general news channel told that now that budget is good, a few lakh Indians will be happy. It's not few lakh, but literally 35 crore Indians have started investing. And of course, we need to go to 140 crore people. So we still have 75% people to touch. And even the people who have been touched in terms of the 35 crore people, many of them need to start trading on BSE going forward. So that I think is a second level of problem. But overall, I think it's a happy situation to be in for the entire broking industry, that our numbers are increasing, trading volumes are increasing, the customers are trusting us more. We have provided a tremendous amount of liquidity services to the entire country when it was needed the most. The stock markets never closed even for a second. And I think that is also a testimony to the technological prowess as well as the trust people have and the importance the government has given to the stock broking. In terms of the worst of times, I think all of us know so many brokers have defaulted. Some of the largest defaults have taken place over last couple of years. In last year alone, as per the newspaper reports, more than 20 brokers have defaulted with a varying degree of or varying amounts of defaults from say 2 to 3,000 crore in Karvi to even 100 crores. And so there are different varieties of investors who have suffered a lot when their brokers have defaulted. The SEBI and the exchanges have been trying to provide the IPF Investor Protection Fund to the extent they can. But overall, it is a difficult situation. Why it has come to this stage where so many brokers, pretty much the largest broker defaults, and the largest number of brokers are also surrendering their broking memberships, at least in one of the larger exchanges. What we have seen is because of the fact that the broking industry has become very, very cutthroat in terms of the commissions they are able to charge, because the larger brokers there seems to be a race in collecting the number of customers and making them trade. The charging on a traditional basis by way of the commissions or brokerage, as we call it, has come down pretty much close to zero. In fact, there are other brokerage houses which are playing on that. And I think that trend we have seen when in 1991-92, the official brokerage itself was 2.5%. On top of that, sub brokers and other charges used to be very large. And now it has come down to close to zero or a fixed cost per month or fixed cost per year. And that is affecting very small brokers who are not able to sustain their operations. And due to that, they either end up taking the customer money on basis of discretionary or discretion, and they may end up losing where they go belly up and go default, or they try to surrender. Whichever way, I think it's going to be a tough situation for many small brokerage houses unless they kind of catch up to the technological changes that are taking place and the ever-changing compliance route based on these defaults and other things. The regulator also has to act, and that's where they are making many regulatory changes, which are also requiring technology to change, the back office processes to change, front office processes to change. So I think there are many changes that have happened over last 1 year, but there are many more changes that may happen due to the way the difficult situations are coming up from the broker side specifically, especially defaults. In terms of the algorithm trading, I think it has become even more overwhelming than what it was before COVID. So although many people have joined the markets, the algorithms are even larger in terms of their presence in the markets, the arbitrage, non-arbitrage, um, even eating up of news on automated basis and placing orders. All these are pretty much prevalent in India. The risk management is becoming very important for brokers and exchanges. Surveillance related issues, financial intelligence unit related reporting, PMLA and other things are also becoming very important for brokers to keep track on. The technological changes and the cost are also increasing manifold because of the incessant changes that are happening due to competition as well as to the compliance requirements and the regulatory changes. In addition to the new products that are coming, a lot of products have started coming into Indian markets, including commodities, which you had separate markets. Now you can trade them on BSE also. Now BSE also offers even agricultural spot market under a new platform called Beam. BSE also offers mutual fund distribution where almost 1 crore transactions per month are happening. Almost 1/3 of all transactions in mutual fund are happening through BSE Star MF platform of BSE, which has become extremely successful, very low cost for everyone, and very, very automated. And similarly, BSE has also started recently insurance distribution, where the brokers may be able to give, or their sub-brokers may be able to give even the insurance related activities in general, life, health, auto, anything you can think of. So overall, the trading part, where the numbers are increasing, at least for the public consumption as an aggregate basis for exchanges, is a heartening news. But at the same time, it's not evenly distributed. So some of the larger brokers are capturing larger market share. Smaller brokers are trying to move out or are declaring defaults and putting a lot of other people in trouble. At the same time, the algorithms are becoming hugely effective and hugely important, not only in India, but across the world. The brokerage rates are coming down. The new products in form of the insurance and the mutual funds, the derivatives, the commodities, currencies, everything is coming. And for me, sometimes it may look very confusing for brokers, especially the small time brokers, how to handle it, how to comply, and so on and so forth. But that is going to be the pace at which India is going to change. Probably even further changes and faster changes may happen. So we need to tighten our seatbelts and ride through this moment. I think, as I always say, that broking is like riding a tiger. The ride is very uncomfortable, but if you get down, it eats you up. So you need to continually be in search of newer things due to competition, due to technological changes, due to regulatory changes, due to compliance requirements, and many other things. So with that, I wish all the brokers of BSE and everyone else associated with this industry very, very best for the year 2021. And also think that all of us need to work very hard to stay at the same place. Thank you.
It was a pretty exhaustive speech. Actually, you have captured the best and the challenges of the industry, and very aptly said, it's like riding a tiger. You have to keep riding, because the moment you get down, you have a problem. But from the broking industry perspective, worldwide technology is actually removing the intermediary or the middleman from every aspects of our lives, isn't it? So will brokerages then go out of the system at some point, or how do you see it evolve over the next 5 to 10 years?
So I think this I have been telling for last now 25 years since I set up NSE in '94. So now it's 27 years that the volumes are going to grow up because it becomes easier because of automation only to do it. But the other side, the brokerages are coming down, and pretty much you have to continue to add value in other areas. So the broking at earlier stage, when say 30 years back, largely used to add value through the floors, by going into the floor and getting you the best price. Now that is pretty much eliminated. The entire value addition has been eliminated by creating a single virtual floor across the world for all the investors of the world. And so that portion which broker used to add has gone. But some of the other areas which they used to add on value, remained over last 20, 30 years because the technology had not changed that much in terms of the back offices, in terms of the risk management, in terms of settlement timings, aggregation and all. So many of those things are also slowly going to go away. The way the floor went away, many of the value additions the brokers were doing or brokers are currently doing might go away, which will mean that there will be newer exchanges may come, which may allow directly the customers to trade on the exchange rather than going through the brokers. Or many products may come which may not require the brokers to be there, or automated brokers like many brokers today don't even touch anything. It's a direct to market kind of orders. And so there is no physicality of a broker. And so once you put the machine doesn't get tired, the machine doesn't get confused. It does exactly what it is told day after day, minute after minute, second after second. And so there was basically the human value addition in many areas are going down. But the other side, there is the wisdom side about where to invest, how to invest, product distribution side, because trading is not the only thing in the stock market. Ultimately, you need to have IPOs, you need to have somebody taking you through that, somebody basically explaining to you the businesses. And so the portfolio management, you can see so many people starting their portfolio management activities and actually becoming successful. There are many new mutual fund distributors have come up who we had not even heard of 5 years back. But in Star MF, there are at least 30, 40 mutual fund distributors who have got literally 20, 30, $50 million of funding to basically do distribution on Star Mutual Fund itself. And so newer businesses are coming up, newer style of businesses are coming up. And that's what every broker will have to figure out, that it's not the traditional part which we are used to, probably you are doing as a family business for last 100 years, 120 years, is going to remain the same. No, it has actually changed drastically in the last 25 years. But in next 25 years, it's going to change completely. And so you need to be ready to figure out where you are good at, how you can add value in newer ways, experiment, and see whether you are successful, able, and not only successful, able to actually derive some additional margins for yourself, because you can be successful and still not have commercial value coming out of it, right? And so these are all important issues which each broker needs to worry about, think about. Even existing successful people also will have to think how the new breed which is coming is going to eat your lunch. So it's going to be very, very tough ride for everyone.
Right. Sir, you talked about directly to the market. So are you at some level hinting that a direct market access kind of thing will become a reality for retail investors at some point?
In a way, it has happened. See, today also, when you place an order on a website of ICICI Direct or a Zerodha or somebody, there is no human involved. Right. It's going straight into the exchange. And so there is no human involvement. Now, is it that the brokers have to be always there in the middle? Probably no. In fact, there was some news item in ET itself, I think 6 or 8 months back, that there is some movement on considering a direct kind of involvement. And so it remains to be seen. Like in currencies, banks as customers participate directly. Similarly, in mutual funds, many large corporates participate directly as customers. So there are instances where the brokers are not coming in those particular areas. But slowly, when technology goes forward, you will see even the regulator experimenting with many such things, if not in India, abroad. And we have to be ready. See, India has been a pioneer in thought process relating to automation of stock exchanges and the entire ecosystem for last 30 years. And so many things which have come out of India, then rest of the world, even screen-based trading was not so screen-based even in US or Europe even 25 years back. We became successful. That's why they went into screen-based trading. And so we have been pioneers in many ways, and we have maintained our leadership in terms of the technological thought processes. And probably, who knows, if SEBI allows, now they've also started Sandbox, where the new technology companies are allowed slightly lower regulatory burden to experiment newer things. So you don't know what the regulators will allow next, and every broker has to be ready. I don't see nobody will, like BSE and other 22 exchanges were existing. before NSE came. And in a year's time, NSE took away a lot of market share, right? So it's not a given business that it remains yours. We will have to, all exchanges, all brokers will have to continue to evolve based on new regulations, new technology, competition, compliances, everything continuously.
Right. You also said that the brokers should probably try and continuously diversify their product offering. But the problem there is, in terms of regulation. Now, if you want to sell, you cannot advise, that's the regulation. Or if you advise, you can't sell. Even in terms of the fee that you can charge, there's a cap on it. So how does one create a sustainable business in such a situation? Do you think that there should be some easing of regulation somewhere there? Because there used to be an industry, and that industry is now shrinking like very rapidly, and that community, doesn't have a very bright future looking forward.
No, I think you are right in a way that the regulations have come, regulators and regulations have changed drastically and have been changing very, very rapidly, which has affected some portion, but that also required the industry's feedback, because many of the feedback the regulators got about the advice people were giving and churning the customer portfolio into NFO again and again and again 10 times in 1 year, taking away 20%, 2% per round. And then at the end, the customer is left holding with 80 rupees when he started with 100 rupees, because the advisor took away the distribution money. And so that's how they had to come out with this, if I recall correctly, the way Mr. Bhave had explained in 2011 or 12, why he had to do this. And so I think a bit of both is required, a little bit of changes in the regulations, but also the over sort of reliance on only commissions coming out of the mutual fund industry. Instead, the SEBI wants you to earn directly from your customers, and if you're adding value, nobody will have any issue in paying you, right? And so that's where I think that was the argument Mr. Bhave had given, and I, even after probably 10 years, I still think they must have come across something which made them take that sort of stand, right? And despite that, the industry has grown many-fold. So it's not that industry, many of us thought industry will stop growing after that, because there is no incentive for the people to subscribe. But in fact, because the industry became so tough in terms of the customer money, that now industry has actually grown many-fold, which nobody actually expected. And many mutual funds have gone up 10 times, 100 times, So for me, each sort of activity has many sides, but I do agree that we require some amount of handholding in India, and the regulators probably can sort of look at it or relook at the entire thing with some more controls and other things going forward.
Also, you have mentioned time and again that the regulatory changes have been very rapid. In terms of from an industry perspective, do you think is there a kind of a wish list that SEBI should probably put out a roadmap that we are going from here to here? Because then probably you make the industry ready for those kind of changes, because the things like like the margin issue and all those kind of things, it has been a kind of a big setback, at very not very opportune time.
It's very similar to the farmers' agitation, that last 25 years it has been discussed, and when it comes, people start agitating because they don't. They want all the benefits, but they don't want the attendant or consequential other issues. Similarly, even this margin thing, it was very well known that some brokers are misusing, and the system allows you to misuse. Now it was up to the broking industry, and it's not today's. Last 25 years, this has been discussed, and everyone hopes that it won't come tomorrow. It will not come in my lifetime, and so on and so forth, right? But when Karvi happens, when Anugraha happens, the regulator has to act, right? They have actually waited for very long. If you look back, it is not sudden at all. It's not, it's almost similar to the Farmers Act and the Farming Acts. It may look like today it has come, no. And still the amount of time that is given, the discussions that are done, literally on NSE side and later on BSE side, I have been party to this many years, so I know some of these issues which are being now undertaken are actually 25-year-old, and no media is talking about it. See, again, media also has to have a path. Ne? It cannot be only the regulators. The regulators have to act based on the realities they face of the invest. Ultimately, their job is to protect the investors, right? And so they will have to look at it. But even onus is on exchanges, on the broking associations, the broking groups, to say that this can be potentially misused. So let's try to change SEBI, and we give SEBI the forward path to reform ourselves, right? And that we don't want to do. But when somebody comes with the regulations after 25 years, we want to blame them. And that's where I think somewhere at the same time, whenever SEBI does anything, I have not seen things happening in one day. They go through a tremendous amount of discussions, debates, consultative papers, public opinions. Over last literally 12-15 years, I have not seen them a single regulation which has come without that. Even the most urgent stuff also, they try to go through that process to make it a little more exhaustive. But somewhere on the line, I think onus is on all of us that we service the clients, our brokers and ourselves. And if they have a problem, if the clients have a problem, investors have a problem, we need to anticipate, tell SEBI that, okay, this is the regulation. We want you to come to reform us. And that is, I think, should be the way that what is our broking industries, or what does the media, business media thinks about broking industry's path for next 25 years. Let's see. Yeah. You guys also watch us.
Good point. Good point. Sir, you mentioned Karby episode, and of course, it is still under regulatory purview, scanner. But the perception in the market is that probably the stock exchanges may have turned a blind eye and let things slip out of hand, or let's say maybe failed to see through what was going on. Can you give us some perspective where things really went amiss?
In what sense?
Karby, in terms of some say that the stock exchanges were probably aware of it, or probably were not very strict in enforcing the discipline.
That's why I'm saying, see, the exchanges basically follow the regulations. If we try to be more stringent, then brokers or the users can complain. And similarly, if we do it less, then the SEBI would take us to task. So there is always a fine line that any exchange needs to maintain. Frankly speaking, if you look at the last 20 defaults or last 30 defaults, you wouldn't see BSE's name there. Any customer money going away, you will not see BSE's name there, because BSE is hugely stringent compared to anyone else in the economy today. But that also tells us that because we are so stringent, our volumes are less. And that's why same people who are asking me this question, like you, will say, though, but you are not as successful as the others. Because we think ultimately the investor money is sacrosanct. And that is the holy grail of our industry. Trading volume cannot be a holy grail, right? And so for me, and similarly, making people trade incessantly cannot increase the wealth of the nation. Wealth of the nation can increase only by investing in good companies and their profits going up, not by trading every day for like lakhs of crores or 40 lakh crore and 50 lakh crore a day, right? And so but the media gets excited about it. People get profits, brokers get profit out of it, exchanges get profit out of trading, not out of the India creating wealth, right? And so there is a dichotomy. And how do we create that framework where what is good gets remunerated and what is not so good gets blamed? But it doesn't happen, right? And I think some blame, as much as exchanges have to take, I think media has to take also, right? That I have not seen much incisive comments from anyone on many scandals that have happened over the last 10 years.
Right. I have run out of time, but one last question I have to ask you is that there is a lot of talk about how this new margin rule affecting volumes and this Karby episode. And of course, we have plenty of new investors coming in. But at BSE, last time we spoke, I think you said that you were turning BSE taking it beyond being a stock exchange, probably into a fintech company. So in terms of your own bottom lines and top lines, you have kind of immunized yourself from this volume fluctuation?
In some ways, it's what I call a path. It's not that we have reached a destination, and it will take some time for us to become a little more robust than what we are. But today, this year, we are doing very well compared to what we did last year, for example, in terms of the operating results. Also, we are continuing to invest in newer areas like India International Exchange, which is in Gandhinagar, GIFT City, in our insurance platform. Our IPO platform is now very, very large. Almost this year alone, we have raised a 15 lakh crore as BSE from equities, debentures, bonds, commercial papers and all for the corporate India as well as governments and municipalities, right? And so our IPO market, our mutual fund business is now exceedingly strong. And so we are, as you said, we are going into newer areas. We have just started a agricultural market for spot based on the new farm laws. And we just are in the process of starting a new electricity spot market with Power Trading Corporation, for which we have now got the approval after 2-3 years. And also with ICICI Bank. So 3 of us have jointly decided to start this. It took us 2-3 years to get the approvals, but I think by this year, month end, we should be through with that. So probably in the next few months, you might see the trading in one of our associates in power also. And so we are slowly getting into larger number of areas, more remunerative areas for us. We are also taking our brokers, smaller ones, even the larger ones, into areas which they have not thought about going into before by providing a organized platform for them. And we, of course, do everything with the approval of the regulator. We don't do anything which regulator doesn't approve or doesn't want us to do. And so it remains much slower than what we would want them to be, or much smaller number of areas than what we would want ourselves to be in. But I think overall the flexibility that SEBI has granted us has been phenomenal. And we have also worked hard as a team to develop those technologies which we are able to, PCs which we are able to fit in as and when the new products are allowed. Like commodities, we started, now we have become the second largest commodities markets in India, right? Equity derivatives are also doing very well in BSE itself, but also in GIFT City. And GIFT City now, INX, India INX does 3-4 times more volume than Singapore Exchange in Nifty. And so it's just that, again, media doesn't see it at all. And so many things for us. I take some of this opportunity to also sort of make people aware that look at GIFT City also, which is now becoming very large. Even in gold, the GIFT City INX, India INX does more volume than DGCX, for example, right? And so there are more interesting things happening for BSE. And it has become a very robust organization in terms of technology, in terms of finances. We also kind of deflated our balance sheet by huge margins over the last 3-4 months. In the last 3 years since we got listed, we have given up almost 1,500 crore rupees from our balance sheet to our investors by a buyback or dividends. And so we are basically trying to use our capital more efficiently, keep only the money which is required, and still get into more areas, more businesses, and hopefully, who knows, some of them like mutual funds might become blockbusters.
Absolutely. Wonderful, sir. Thank you so much for your time. And
Thank
it's
you.
always good to talk to you about the market. And you have been
Same here, sir.
one of those leaders who have seen the market grow through from probably 1,000 to 15,000 on Nifty and Sensex. I'm not sure. I think you would have seen it from maybe 2,000.
Yeah, probably in that range, 1,000 onwards. Yeah.
Yes, 1,000.
But Nifty was created by me.
Yes. So
And even Nifty's predecessor called NSE 100 was created by me.
right. So no better than you to talk about all these issues. Thank you so much for your time, sir. Thanks.
Up next, we have a session that focuses on how the broking industry is balancing the growth in aggregate revenues with operational challenges and compliances.
Welcome to this session today. Indian broking industry, what has changed and what's coming? Since the banyan tree, Indian capital market has been synonymous with its stockbrokers. And now the market is has gone much beyond stockbroking, and stockbroking becomes a smaller and smaller part of this entire scheme of things. But this industry is where everybody has always had interest. These stockbrokers have been your friends, philosophers, guides, advisors, all rolled in one. So today is a session, a discussion on how the stockbroking stands. What do we see it going ahead? What do we see the present and probably a bit into the past? Always nice to go there. To help us on this topic, we have some very, very powerful people on the panel. We have with us Mr. Nitin Kamath, founder and CEO of Zerodha. Does he need an introduction? I doubt. We also have with us Mr. Vijay Chandok, MD and CEO of ICICI Securities, Mr. Srini Vishwanath, who is the co-founder and CTO of Upstocks, and we have with us Ms. Samriddhi Chaudhary, who is the Vice President and Co-Head of Financial Sector Rating ICRA. So welcome, fellow panelists. Let's hope to have a very interesting discussion on today's topic. So let me start this discussion with a small question, okay, which is probably the most powerful one. The stockbroking as a business model. All right. We could look at Kal Aaj Aur Kal. So if we go back in the 60s and 70s, so the stockbrokers are merely execution services. Truly. So we had the ring and people used to place the orders, and that's about it. To today, now stockbrokers, either directly or through the group company or through the subsidiary, they are doing advisory, execution. They're doing funding, either in the NBFC or in the margin trading books. They're doing wealth management as a PMS part. They're doing mutual fund distributions, everything. So this is the today, and then we have the fintechs who claim to disrupt, but probably everybody is becoming fintech nowadays, and all businesses are effectively technology company who also do some other business. So some thoughts on what do you see today, and what do you see of tomorrow? Starting with maybe Nitin.
Hey, thanks, Uttam. Yeah, no, I mean, yeah, like you just mentioned, right? I think everyone today is fintech. So I don't think, not just in fintech, but across different industries, I don't think you can really build businesses without tech anymore. I've been trading the markets from I think late 90s. So what has happened, I think, in the last 20 years is that you now have a breed of brokers who are truly only execution only, like someone like us. While we distribute mutual funds, we're still not really advising any mutual funds. We are just enabling people to purchase mutual funds through us. So so I think whatever has happened in the last 15-20 years has led to this, right? Which is be it us or say be it even Upstocks, I mean, we are all focusing on building better execution platforms to the customers. So what is the future like? I think there will be more of these execution platforms like us, and there should ideally be also advisory first platforms. I think what India is missing is really an advisory ecosystem, because let on their own, will customer do the right things? I'm not sure. So there is a bunch of brokers who have the legacy and who are born and brought up with advising people on what stocks to buy. I'm hoping that there'll be a niche that gets built here, which is brokers who build platforms which are advisory first, who are helping customers make the right kind of decisions and etc. And hopefully we also have an standalone advisory ecosystem, which is again missing in India, which is advisors who are not brokers, who kind of use execution platforms like us to advise on top of them. So so I think that's really what I think the future maybe looks like. So which is a bunch of advisory brokers, a bunch of execution brokers. But execution brokers not trying to advise, advisory brokers not trying to compete in terms of pricing or in terms of platforms, and advisory only platforms as well. So,
the regulator also has been indicating very strongly that they want advisory and distribution to be separate. Okay, that's a message we're getting constantly. Shrini, would you like to add on what Nitin said, or just add on more on this issue, on business models of what's happening to stockbroking industry?
Yeah, sure, no worries. So I think what we had before was generally you couldn't sign up with a broker without getting a little bit of advisory from there. You had to have a relationship manager that was required to open your account, because not only was it cumbersome to open an account, but many people also did not know what to trade. In the last decade and a half or so, we've sort of started seeing the unbundling of services, right? Initially, you sort of saw Sharekhan come in the early 2000s, come and create an online only model. And even then, people required some level of advisory to help them walk through that. In the last 5 years, we're seeing a whole new breed of customers who are not necessarily in the larger cities of India, but they're in more remote towns, and possibly it's not easy to get advice and things like that, but they've sort of overcome that hurdle and are still looking to kind of participate in the market, right? And that's where the execution-oriented providers come into play, where it's a pure play execution model. You know exactly what you want to buy or sell, and you're just looking for someone who can do that low cost, reliably. And that's when we saw this whole new breed of brokers coming in who focus exclusively on just solving that one problem and that one problem only, right? Because advisory has gone away? No way, no chance. There are a lot of folks who still look for that advice, who still feel that they can't, understand the stock market and digest it alone by themselves. So that's why even if you look at other countries, it's never that because discount brokers came in or anything that the other brokers were sort of were relegated on the side. They also actually grew by a ton because a lot of folks in discount brokers realized they needed advice, and then they sort of moved into an advisory model. And then I think the second thing that we sort of started happening is you have companies focused purely on execution, like Upstox, Zerodha, and who else, but you also have companies purely focused on just the advisory aspect of it, right? So they help on just the advisory aspect of it, and then they work with brokers who focus on just the execution aspect of it to sort of link that together, right? So that whole unbundling of services has happened with each player focusing on that niche area and trying to get that really perfect, and has created this interdependence ecosystem where you have folks managing wealth management, some folks who manage advisory, and then you've got execution-oriented players. And I think it's come out pretty well so far where we are today compared to 10 years ago. I think it's done a great job of kind of having a separation of concerns, and they all sort of play together to give the consumer the best option that they want.
Thanks, Srini. Vijayji, so basically, I would turn it around and say you are into bundling 3-in-1 accounts, very loosely speaking. So I think from what I gather as my discussions with the investors, and one of the biggest things that bank subsidiary stockbrokers bring is the trust factor. All right, I'm sure being a part of a smaller part of as a part of an institutional setup gives a lot of support and faith. So what do you think, how is your business model playing vis-a-vis the other business models which are coming in as a bank broker or as a professional? What is your inputs, or what do you feel how the markets are going, the business is going?
So thanks, Uttam. I think one thing is very clear. Life is never static. Lots of changes are happening in the environment with respect to technology, with respect to understanding in the way in which you can imaginatively use analytics and marry it with technology, and even the behavior of investors. I think a lot is changing. To my mind, the future is not going to remain the way it is just now. Yeah, I completely agree the way the stuff has evolved. My co-panelists mentioned, and some of the elements of what they sort of predicted or projected forward could potentially be outcomes that can arise. I would just add two bits to that. To my sense, it's very important to keep customer at the heart of what we are trying to do. And I believe that the customer is eventually coming to the markets to increase his wealth, protect his wealth, make money. You've got to help him in that journey. So how you're going to do this, advice, tools, using technology, and you have to do it his way. It's not like, an amorphous one shoe fits all kind of a style. I think you've got to do with great degree of personalization his style. I also sense the generation which is coming forward are digital natives. They are very different from the millennials. Many of the millennials are savvy on technology, but they are still not digital natives. The generation that's coming today, they are digital natives. They are born digital. They think very different. So their expectation is absolutely acute personalization, sharp personalization, n equal to 1 kind of a expectation. And I also believe that they are heavy into social. So they want to exchange views, they want to interact with one another, they want to, in some sense, like we've seen democratization of markets, participation. I think people want to become advisors. So if you can, evolve into getting that kind of a stuff happening, I think the new age guys would adapt. I'm just borrowing from what we are seeing in China, for instance. I think it's inevitable that we will go that way. So I would believe there'll be a lot of excitement in the next few years. And I don't see this very far away, actually. Next 2-3 years, things will be vastly different from what we are having today. I think even the definition of trust is evolving. You did mention that coming from a banking setup, you offer a kind of an institutional comfort to investors. Yes, that's true. But I think the dimension of trust is far larger than just the comfort. And I think we need to recognize that, because today, when you're saying that you need to be a trusted brand, the customer needs to be convinced. Not only are you going to be doing things safely for him, you're going to be guiding him for the right areas where he should put his money to. But also, he wants to be damn sure that you're doing your bit to ensure he gets what is the best that's available anywhere in the world. So he should feel that, okay, if I'm coming to these guys, not only will my stuff will be safe, that's like base expectation today, but I want to be sure that these guys are up to speed and they're going to give me the stuff that's possible anywhere in the world. So I don't need to look here and there. So we've got a long way to go to reach that level of trust. So we have work to do.
So two things you said. One, people come to the market to make money. My firm is 60 years old, and I wonder. Sometimes I feel half my clients come here just to have some fun. But that's on a lighter vein. But I'm sure that's a topic for investor psychology. Why people do what they do.
Yeah, that's right. They come for fun, provided the money that they want to make is made. Right. Once that barrier is done and dusted with, then you put aside something for the stuff you just said.
So Samriddhi, as I was saying, we are stockbrokers into the business. You are a nice outsider giving a view as a third party, unbiased view. You just did a report on stockbroking industry where we are. Could you like to share some thoughts on how the business models of stockbrokers are evolving as you see them?
Sure. So if you look at maybe the profile of my fellow panelists, that itself is a reflection of how the industry has evolved. While you have disruptors who've maybe changed the rules of the game, there are traditional brokerage houses who have evolved, who've kept up with the changes and adapted to technology fairly well. So I guess with maybe the onset of discount broking, we've seen brokerage houses offer more services, more value add to customers. This could be perhaps maybe trying to shore up the profitability or just to provide like a greater value to clients. This is something that we expect is going to continue. So you are going to have advisory, financial planning adjacent, maybe robo-advisory, technology-based advisory services. You're also going to have maybe more of margin funding, which is picked up quite well in last 2 years. So this is something which is going to continue. Definitely focus on technology, or using technology to better maybe the services that are being provided, the quality of service. That's also something that is going to continue. But having said that, looking at maybe how vast the country is, our demographic profile, there is enough room for the technology based as well as traditional brokerage houses. We are going to have the mix of physical presence as well as maybe a complete digital setup.
Thanks, Samriddhi. Actually, that kinds of leads me to the next question. Such a large country, how many intermediaries do we need? Do we need intermediaries, frankly speaking? And this is a question not only in India, where intermediaries throughout the world and throughout businesses are facing. So, some numbers today in NSE cash segment, which is the largest cash segment, there are 820 active members. That number used to be more than 1,000. The registered numbers are higher. And as we talk to people around, people are shutting shop. They are just unable to meet the regulatory expectation. It's in the last year the cake has gone up. So even if the share of the cake has gone down, people are making good money, which also comes out in your reports from Riddhi. But that issue remains. Do you think consolidation will happen or shutdown will happen? And does the panel believe that we'll end up with 10, 20, 30, 50 serious intermediaries in the stockbroking space, and everybody else will disappear because of sheer economics or regulatory, not being able to meet regulatory expectations? Again, another piece of data: out of this 820 members, around 150 odd members have proprietary business as the main business. More than 50% of the turnover is either proprietary, or almost 100% of the turnover is proprietary. And if you take some few niche stockbrokers who just handle a couple of HNIs, there aren't too many stockbrokers servicing the country. And does technology make it necessary? And taking it forward, why can't exchange service the clients directly? What are stockbrokers doing there? Except that the law requires that the trades has to come to a stockbroker. What are stockbrokers doing here in the first place? The fact that now that the SCRA is being rewritten in terms of code, I think that's a question people will ask. Ki, kya karna hai? So, any thoughts? It's a very dangerous topic, but I thought this is a right panel to ask these questions. The same sequence, or if somebody wants to, yeah, Vijay.
Let me go. Yeah, I think it's a great question, and I think it's a right question to ask. I think nobody has got a place under the space just because you have some history with you. You've got to earn. You've got to add value. If the entity that we are is not adding value, we have no place to exist. We have to be prepared for that. So today, are we adding value? I think we are adding value today. Will we continue to add value? It totally depends on us, whether we continue to evolve and keep ourselves relevant. If we continue to do what we are doing, there is going to be this question which you just asked. And if you are not able to give an answer, you can't seek umbrage in law. That's not the way stuff works in a system like this. So, right questions to ask. The questions is more for internal sort of soul searching for all of us to keep evolving. To figure out, okay, if this business is now shutting shop or it's not going to be relevant, figure out something else you have to do. There's no other option. So at least that's the way I think. For now, yes, there is value that is being added. At least global experience tells me that so far, even the most evolved markets, the entity called brokers do exist. They continue to exist even now. But I don't think we can take things for granted, because all you need is one more new disruption which sort of changes the way in which things are getting done. 3D printing has now made manufacturing of certain items redundant. Who would have imagined you can make stuff without having a factory a few years back? But it's possible. So why do you want to say that broking is got a perpetual life? I would be not surprised at all if broking eventually as a concept is eliminated. We should be prepared for that.
So I think why brokers are required is to take the risk on their head. right? Because if there were no brokers, exchanges, the MIs would be taking systemic risk. So, right now, essentially what we are is this cog in the machine, which takes risk out of the system, right? And unless the regulators can somehow figure to ensure MIs don't end up taking systemic risk, I think brokers will be required. But if say, somehow there was a way to ring fence the MIs from any kind of collateral damage in case of volatility, etc., do we need to be brokers? Not really. I mean, we can be tech vendors or whatever. Right? I mean, you're M-panel vendor with the stock exchange, and you get to choose which platform you want to trade on, right? But I don't see how you can, we brokers will continue to be required. But do we need 650 brokers, retail brokers in this country? I don't think so. I mean, I think, regulation should make it easy for brokers to consolidate and merge and get together. And because today, every time you merge, you have to redo the KYC and onboard the customer again. And, it just makes it extremely complex. I think if merging and consolidation was made easier, I think it'll help. I think smaller brokers have to come together and create entities with some USP, like what Vijay was saying, have some kind of value that you add. Now, if the value is in terms of execution only, I think that fight is going to be of who's got a better product, right? And I don't think there's space for more than 3 or 4 really in that space, and I don't think India is a large enough market to, I mean, even if you look globally, right, as in even a large markets where people are fighting on pricing and product, there isn't really space for more than, I mean, there is space, as in the guy after the 4th place is probably losing money running the business, right? So I don't think execution, there is even space, like I said, right, for more than 4 or 5. So really the value has to come in terms of advisory. But like what you said, Uttam, is that regulations are trying to keep distribution advisory separate. So how will broker, advise if they're not supposed to advise? So what are they really going to do? Question. So I mean, that's another, that's a question probably we need to ask the regulators, saying what happens if, all these brokers who can't really compete in terms of execution can't even do advisory anymore. So what is really the role in the ecosystem?
To quote a few numbers over here, while the total number of brokers might be very large, but if you look, am I audible now?
Yeah.
Just to quote a few numbers over here. So if you look at maybe say top 20 brokerage houses, these would attribute to over 85% of total active clients on NSE. The total number of brokerage houses would be much larger. The same ratio used to be about maybe say 57, 56% a couple of years back. So definitely consolidation is something that is happening in the industry and is going to happen further with, the compliance requirements, the regulatory ask, technology requirement is going to perhaps drive smaller entities out of business. We would also see maybe smaller entities taking up like a sub-broker position with a more reputable franchise. And this is something that has been happening. We expect this is going to go on. Your other point regarding maybe the entire requirement of having brokerages at all. The exchanges right now are handling maybe thousands of brokerage or brokers as clients. The ask for having hundreds of thousands or lakhs of retail clients. I mean, the ask for the system, technology, the MIS, that's going to be much different, and that's a different level of responsibility as well. So I mean, if brokers are here to stay, I mean, that's what I would think.
Happy to hear that. I still have a future. Srini, yeah.
I mean, we're looking to convert a B2B to a B2C, right? If we're asking the exchange to start servicing clients. So even having that transformation as a company is not easy. And of course, you have other benefits like MIS and the other sort of, de-risking the ecosystem by not having one player sort of own it all. I think it's a big reason. I think everyone's brought valid points towards that. And also, if you look at, outside India and the US and things like that, sometimes you see it actually working the other way around, right? So the brokers sometimes even act as exchanges by actually crossing their own orders instead of sending it to the exchange. So that is great because it's, could be cheaper for the customer, and it's also less load on the exchange. Of course, it has its drawbacks too. And the other end is that, in outside countries, you also have more than just two dominant exchanges. There's a lot more exchanges out there, and everyone has to play fair, and that the best price execution wins for the consumer. So I don't see the concept of sort of, the broker also going away. And I think if the exchange wants to get in and offer, or SEBI says that, the exchange should be also allowed to offer that, I think that's totally fine, as long as everyone has an equal playing field to innovate. Ultimately that's all that matters, right? On the second point of the number of brokers dwindling down, I think a lot of this is also just because anytime technology comes into any industry, right, whether it's entertainment, whether it's ride hailing, whether it's e-commerce, technology has this effect of sort of giving that winner take all, kind of a thing. For brokers, I think a lot of them will have to kind of pick and choose, right? If they're running both prop trading and retail businesses, they have to pick where their focus is, right? And if they want to get into retail trading and that too looking to scale to a large number of clients, it's extremely important to invest in technology. That's step one. And then once you invested in technology, the next step is investing in products, right? Once your technology base is done. So that level of focus and commitment has to be there if they're looking to sort of get in and compete at the mass scale. I think other things like the regulatory changes and compliance changes are there, but I think the larger headwind for folks is going to be, do you want to focus on being a B2B and go into prop business, or do you want to get into B2C and, invest a lot in your technology and product?
Thank you so much for that. 2 points that come in my mind. Nitin made a very interesting point where the brokers, the clearing members, we are kind of lubricants to the system. Like when there's a financial shock or there's a lot of fund flow, they become a sponge where their personal network, their personal resources are available to meet settlement obligations in case of sharp movements. However, the fact that they are lubricants also gives them some leeway over the client assets, and which we have seen some really bad experiences in the recent past after a dull of Shanti. And though the regulator has come down heavily on the security side and kind of cleaned up the system where it makes it almost impossible to do any hanky-panky there. Plus, even on the fund side, the monitoring is very sharp. We're unlikely to see any major stupidity in terms of misuse of client assets with the kind of scrutiny we have. But on the other point, if the stock exchanges decide to be stockbrokers, why can't the stockbrokers try to be stock exchanges themselves? Wouldn't it work both ways? This was the last discussion paper. We said India doesn't have sufficient stock exchanges intermediate. Let's have more of them. Let's have fintech companies running stock exchanges. Well, that will be a very interesting discussion. Probably a full panel discussion we can have on this topic. But moving ahead on a third part, regulations in the capital markets and how it affects stockbrokers. Regulations can make or break business models overnight, right? And our regulator is a very powerful regulator who is not scared of using his powers once they believe that this is in the interest of markets. If we talk about intermediaries being disruptors, our regulator should be called disruptor in chief. Because if they see that if this disruption is going to lead to some benefit overall, especially from retail investor point of view, they won't think twice. They move ahead. You may keep screaming and shouting and crying out bloody murder, but nothing's going to change the mind. Do you think, please be politically correct if you want to, but please do give your mind. Do you think that Indian regulator is just right, probably a bit overdone on regulations or micromanagement, or it's too less, they need to do more? Or can I dare you to speak something on this topic? Anyone can take this.
Yeah, tricky one with them. So, no.
So I could go on this.
Vijay.
So, I've had the privilege of actually witnessing regulatory thinking across industries, broking now, but earlier in the banking side, and not just within the country, because as a part of the person heading the international business, I was overseeing almost 16 countries where we had a presence. So it was OSFI in Canada to Bank of England in UK, the US regulator in between, and then Hong Kong, HKMA. So Singapore as well. And these are damn sort of advanced regulators in terms of their thinking and in terms of their approach. And this was at a time when we actually just were coming off the global financial crisis 10 years back. So that whole period of transition, I was dead square center facing them. And let me tell you, when the regulations came the way they came, there was like complete, the industry was in a complete disarray, because the stance taken, not just the text of the regulation, but also the behavior of the regulatory sort of system dramatically changed, and it changed vertically in a very short period of time. So there was a lot of pent up, I would say, feelings within the system, within the banking system globally. But nonetheless, I think the regulations that have come, initially people felt, it's not going to work. It's too much of an ask. ROEs are going to plummet in the banking system, and so on and so forth. You're 10 years into these regulations. It's only gotten tighter in the last 10 years. It's only gotten tighter. And ROEs have bounced back. The banking system is far more stable. Today, investors say that, COVID came, COVID is going, hopefully. And you've not come across an accident. It is a testimony to the kind of thinking that the regulatory system is doing. I think likewise in India, I have seen, when I contrast the thinking of regulators, the Indian regulator has been, I would say, far more proactive than what we've seen. The extent of foresight, now with the benefit of hindsight, you can say it was foresight, the regulatory systems have got, has ensured that, we have not really gotten stuck in any of these various sort of accidents that have happened globally. And in that context, to my mind, whenever new regulations come, and lots has been coming in our industry in the last few years, and I'm sure it's not ending anytime soon, it does create feelings amongst players for sure, because it does have a short-term impact. But I think a good way to think about it is that the point that you said, they eventually land up for the good of the customer, for the stability of the market. And all that becomes evident in the medium term. I was actually checking out various regulations which have come in the markets in the last few years. And every time it came, there was that, there's going to be a big impact and so on and so forth. Yeah, 1 quarter, 2 quarter, yes, we did see. But you take a trend and you'll just continue to see that kind of a growth momentum. That's because so much of under-penetration is sitting within the country. So that comes and takes shape and fills it up. So my view is that anything good for stability, preventing shocks, good for the retail customer, eventually in the medium term plays out well. And I've seen it in India, I've seen it outside India. Very similar responses across industries, but eventually it plays out. Yeah, depending on the nature of the regulation, sometimes few quarters, sometimes longer, but it does play out. But I think the important thing is to embrace it sooner than later, rather than trying to resist.
I have to add here, we are as Brokers Forum, we are member of various international bodies, where the securities associations of various countries come together, and nobody is happy with the regulator. It's global. So when you see other people's pain, your pain starts feeling much lesser. Not only that, yeah, the Nitin. Yeah.
No, the thing is, we as a business have benefited significantly in the last 10 years of with every new regulatory change. Right? We came into an existence in 2010 because the short margin penalty rule got introduced in 2009. Because I wouldn't have started this business if the short margin penalty rule wasn't there. Right? Short margin penalty was if overnight you don't collect span margin, at least there's a penalty applied, right? Because until then, brokers could allow customers to hold positions without collecting enough margins, right? So, and it didn't make sense to disrupt in pricing if someone could give so much more leverage on overnight position, right? Once you knew that the risk is kind of uniform across brokers, you now knew that you could now play on the pricing because the risk is kind of similar to all brokers, right? So, and from then onwards, every new regulatory change has actually helped business like us. I mean, maybe all of us on this panel, it must have helped, in some way or the other. Even when this recent GameStop whole incident happened in the US, right? And I recently written something about comparing both the markets and how our markets are probably exponentially better for the consumer as compared to the US market. It's supposed to be a lot more developed as such. But that said, does over-regulation stifle innovation? It can. I mean, right? As in, see, at the end of the day, we are all trying to expand the markets, right? We just have we probably have 15 million Indians who invest in the market once a year, right? So all of us on this panel, we are all thinking on how do you take this from 15 million to say 30 million, 45 million, which means that you have to be innovative, and sometimes over-regulation stifles innovation, right? And but the problem is again, there are brokers who've been around for 30, 40 years or more, right? And regulation is made similar for everyone, right? As in maybe, say we should think of two classes of brokers, right? Like I'll tell you, if we do 5 million orders in a day, maybe 100 orders happen on a dealer terminal, right? Which is almost zero. I mean, we could actually tomorrow morning, I could get up and say, you know what, we're not going to take any dealer orders, right? But a lot of these issues that have happened in the industry has happened around almost wealth products, missold wealth products, right? As in dealers or relationship managers, mis-selling to customers and over trading, unauthorized trading and all of that. When a broker like us, we don't have a scenario for something like that to happen. Should we be subjected to the same regulation where something like that can go wrong, right? So, yeah, so maybe two classes of brokers. One who can't access customer accounts at all, right? As in the sense, if he has no access to place orders on behalf of a customer, maybe have a certain type of regulation for him, create a new category of membership, or maybe, it's just an idea. But otherwise, I think, every time there is a small incident, we are all waking up in fear saying, what is this new regulation that's going to come, which we'll all have to adjust our systems to, right? So yeah, so that's what I think.
I think these are all very good points here. And a couple of things I think anytime some new regulation comes in that, the margin requirement or you got to drop your exposure, everyone is, jumping up and down, and not just brokers, it's also consumers, right? People who actually use that very well. But then I think over time, as Vijay rightly mentioned, it sort of stabilizes itself in the medium term, and you sort of see the volumes pick back up and consumers getting used to it, and it goes on. What is the right balance between risk and also, making sure that the system is running smoothly? We'll never know the right answer, but I think so far it's going in the right direction with what the regulator is doing so far, right? I mean, we've never had any major incident to the system, and I think they've done a good job so far, owing to kind of the business growth and things like that, right? Apart from the sort of margin and sort of securities aspect of it, I think a couple other areas which have been significantly led to, I think, huge participation in the market. One is a KYC requirements, right? So when we started, in about 2012, a customer had to send 31 pages, signed documents in each and every page to open an account. And, if there's one signature that's slightly off, then we would have to mail that form back from Mumbai to wherever that person is, pay the postage fee. That person would then sign that and then send it back. I can't imagine a world like that anymore. And now it's with all the digital KYC that has been made legal. It's just, it's been day and night, that sort of change. I'll go as far as to say that, some of the things that the regulation has done in terms of payments and things like that is better than other countries, right? Getting something like UPI approved for, IPOs and for funding your account. I mean, that sort of real-time money transfer, I don't even think that's widely used in the US. Even in the US, it takes several hours or even days to transfer money into your account. And here in India now, we're so used to just using UPI and just instantly funding that and moving it forward, right? So kudos to them for sort of embracing that, sort of seeing the innovations done on the payment space, innovations done by the government, and then linking that and saying, okay, how do we sort of bridge all this together to make a better consumer experience? But yeah, I mean, anytime any regulation comes in that sort of, we feel that adversely affects us. I think it's just a matter of time that you got to wait it out, and you'll sort of see things come back to normal after some time.
Before I come to you, Samriddhi, let me push my luck here. Look at how India has grown from 1991 till date. Look at this way the GDP has grown. Have our markets really grown as it should have? If I say, for the sake of argument, the regulator has done nothing for the market, he just kept on putting roadblocks. It is the sheer force, the natural force of the market that it kept on increasing and finding its way. All right. Could that be a fair argument? I don't know. This is something probably we should all sit and wonder. Because often the complaint I hear, it's that regulator plays the regulatory role well, but on the developmental side, the regulator is not very enthusiastic. Or maybe it's a false thinking, and then it requires some image change from regulator side. But I'll stop at that. Samriddhi, you want to add something on this, or we can move ahead?
I think if you consider maybe the accidents that happened in last couple of years, I mean, not just brokers. I mean, we've seen with clearing members as well. So if you factor all of that in, I mean, these steps were much needed. And I guess if you look at a medium, longer term point of view, definitely it's going to add maybe say more discipline in the industry. It's also a positive from the investors' point of view, into restore investor confidence, make them feel slightly more secure about where their money is. So there are going to be teething issues. I mean, as Vijayji also mentioned, we have seen brokerage companies adapt to changes in the past. Of course, in terms of the compliance requirement which is there, maybe access of funding which might become an issue. Smaller entities, certain entities definitely are going to face challenges, and how you evolve your technology to be able to manage this, comply with the ever-changing regulatory guidelines. I mean, that's definitely which is going to remain important.
Right. I'll move to my last question for the day. Looking in the future. So we are capital market participants. We are used to the terms long-term, short-term, medium-term investing, value buying, But let's talk about today's topic is the broking as an industry. So I would like you to share some dreams. All right, not 20 years, the 30 years, because it's not possible. In fact, I'll quote my dad who says, if Uttam, you were to go in a coma and wake up after 10 years, you'll find the market totally changed. And this happens every 10 years for those who have been long enough there. But the basic thing will remain, the satta, the buying, the selling, the teji mandi, that will remain. But the way of doing things will keep on changing. So if I could peek into your minds and take a feedback on what do you think after 10 years will be, oh my God, this is something totally out of blue. Or let's say something like, would there be T+1 or T+0 or real time? Would there be direct market access coming to the way that is there in mutual fund, direct or through intermediary, or like even in NPS we have that? Or do we see the IFSC, the GIFT City going crazy? Everybody is setting up PMSs and stockbroking there. Forget India. The world is my stage. The liberalized remittance scheme is the Indians investing and owning the entire world. I'm going and setting up my PMS in IFSC, and I say, yeah, this is my Mongolia fund, and this is my Vietnam fund, and this is my no. Oh, forget India. Let's take over the world, or anything. That's often I sit and dream and ask people, can you dream? And because if regulations don't stop it, Indians will do it, right? Indian businessmen have worked for the last 70 years in spite of government, not because of government. But it's getting better and better as the government gets more progressive, as the bureaucrats get more progressive. I think we'll all come on the same side. But a penny for your thoughts. But this time I'll just change the sequence, starting with Vijayji and then Srini and then Nitin and then Samriddhi. For your, what's your thought for your next report? So in that sequence, please.
Yeah, thanks, Uttam. I think I did allude to some of the things when I spoke earlier. So as we think about the future, I think a new generation is coming. This generation is very digitally wired. It's limitless in thinking. A person sitting in Bilaspur is engaging with somebody in New York as much as anybody else who's sitting in Delhi talking to somebody else in Russia or somewhere around there. So they are pretty connected. Their thinking is global, the way you said, and therefore I would believe it's got, yeah, there will be probably convergence of markets. There would be convergence of even asset classes. So people would flip between commodities, the cryptos. Eventually, it will come. Stocks, a bunch of funds. The nature of funds are becoming more ETFs. You have people like small cases virtually becoming advisors in funds. So the whole industry structure is going to become very democratized. For all you know, there could be smaller cohorts of fund managers who could have their own fan bases, who would be running portfolios, and maybe he does it digitally. He says, okay, I've got 75, 100, 500 followers, and I do my advice, I do my research. Information is very easily accessible. So I would believe that it will be very connected, very social, very across asset classes, very different format, not in the current format. That's how I believe it will happen. A lot of gamified, learning, education will have to get gamified. People are not going to be sitting, listening, reading, maybe a combo of stuff like that. And I don't think all this is very far away, maybe 5 years, less than that. It's already happening in China, so not very far from there.
I think those are great points, right? So I think definitely, Uttam, to your point, if someone wants to invest in a mining company in South Africa or a clothing company in Amsterdam, my dream is that is possible, right? The GDP of our country is growing. The amount of wealth that's being held by Indians is growing. And even not just within the country, but as a relative share of global GDP, it's growing, right? So, why not use that and give that ability to own companies that are possibly not based here, right? If as a consumer, I feel that there's a company that's based outside that could potentially, get a better ROE or ROI on my money, should be able to do that. And I think it's great, the fact that you're able to then use the money earned here to then also buy foreign ownership, which is something that we've never seen before in our lifetime happening at a retail scale. So I think that's something that would be definitely great to see. And the other thing is, to Vijay's point, I would love to see we're at that cusp right now where there's not a lot of people actually investing when you look at the proportion of the total population, right? That is going to start changing now. We're just at that beginning inflection point right now. This is not the end all. As that number grows, you're going to start seeing some of these people turn from novice traders to becoming deep experts at what they do, right? And the hope is that some of these deep experts actually build a presence and build businesses for themselves around, what they've learned, right? It shouldn't be that the advice you get has to come from someone with a fancy degree on TV telling what needs to be done. No, it has to be something. A lot of these things today are self-taught, right? I mean, entrepreneurs today, many of them are self-taught. And then I'm hoping that, the area of securities analysis, fundamentals of stocks, and doing that is actually something that's democratized and spread out rather than held by a clutch of few people who own that knowledge. So those are my two things. I mean, let's, if you want to buy something, any asset that should be made available. And number two is, let's break and democratize the ability to kind of, analyze and dissect and even advise, and the whole aspect of advisory out to the masses.
Let me take one by one. T+0 is going to happen. Okay, I mean it's just a matter of time, right? I mean, yeah, it'll be first T+1 and then T+0, but I think T+0 is on its way, maybe in the next 5-6 years. To what Srini was just saying about allowing customers to buy assets from around the world. I think India, as long as they're going to have this deficit, they will make it tougher for money to be sent out, right? As in, like, we now have a tax collection at source for remitting money, which is, there can't be anything tougher than that if you want to send money out of this country, right? So yeah, if it picks up, I have a feeling it'll become tougher to send money out, like how China has made it extremely tough to send money out of the country, which means that crypto also may not happen in the next 5-10 years. I mean, because that's again, government losing control of the money. And but I think like there won't be 650 brokers. There will be less than 50 brokers. But I think there will be at least tens of thousands of advisors, right? I think one of the things that SEBI has put in the right kind of enablers in place with this RIA rules around RIAs. I think what isn't in place is how does this RIA generate revenue, right? Because today as an advisor, if you want to collect fees, you have to go to the customer and ask him for a fees, right? Whereas in the US, you can actually take it from the asset under management itself, right? I hope one of these days, SEBI wakes up and says, you know what, there should be some kind of a tripartite agreement between these 50 brokers and the customer and the advisor, saying that the custodian of that asset can collect some sort of fees for advisor and pass it back. Because unless there is a way in which an advisor can have some kind of, there has to be some clarity in terms of, what is his cash flows, etc. If there is an advisory ecosystem will mushroom in this country. I mean, we've had, in this whole rush in the last 4-5 years, I think there's this new kind of people coming to the markets who are higher quality, very professional. They spend a lot of time on social media, sharing knowledge. So they've gotten better. I track a bunch of such people. So like what Vijay said, what Srini said, I think there are going to be these advisors who will, I'm hoping at least, maybe it may not happen, but I'm hoping that it's advisory first, because clients let on their own end up doing mistakes, right? And you need professional advisors to be making their customers professional, right? Because people, like Vijay said, don't really have the bandwidth to sit and read, books and etc. And today's world, we always have this distraction called the mobile all the time, right? I mean, does someone read finance or does he watch Netflix, right? I mean, so it's and also the thing about games, what we have seen, we've tested a bunch of things. As soon as what is at play is not real, there's no interest, right? I mean, the reason people come trade the market is also because it's real money, right? As in, I mean, whatever little attempts we have done or we have seen happening in terms of demo money, it hasn't really taken off. So I mean, these are some of the things I think.
Samriddhi, any further thoughts?
I would say maybe like we are already on the path to that, but a wider and maybe easier access to various investment opportunities or methods, a more sophisticated, much more evolved advisory service or advisory system, and a net significant jump in share of wallet of financial products in household savings. I mean, is going to actually tell the truth. So.
Right. So we have had a very interesting session today. Tried to push you guys to really share your thoughts, and you've been kind enough to do so.
Our next panel of the day is the future of digital payments. The adoption and expansion of digital payments has transformed businesses and has been key to India's resilience and growth across sectors despite the pandemic. India is at the global forefront of digital payments. But what will this mean for the legacy players in the ecosystem? What does the future portend? Let's hear it from our panel.
Hello, audience. It's my pleasure to be in front of you and talking to you about this very interesting topic on future of digital payments in India. My name is Kunal Pandey. I'm a partner with KPMG in the digital practice, and I look after the financial services sector. With me, I have two very eminent personalities, people who have spent a lot of their time on digital payments and have worked very closely in the Indian market. First gentleman who is with us is Mr. Sajid Sivanandan. He is the MD and head of Google Pay in India. And we have, with him, we have Mr. T.R. Ramchandran, Country Group Manager, Visa, India and South Asia. These two people, as I said, have done a lot of work in this area, and I'm very excited to talk to them about their experiences and sharing the same with you. Without further much ado, I would ask the first question. My first question is, around the customers. And when we look at digital payments or, payments in general, I think one of the center stage is about customers, and one has to look at how one wins customers. We have seen a lot of focus on winning customers by way of discounts or other incentives. Mr. Sajid, I wanted to take your thoughts and would like you to share your experiences with the audience on what do you think are winning strategies for customer acquisition and things which could be beyond some of these elements of given incentives, etc. So please.
Thank you, Kunal, for the question, and a big thanks to EG for having me here as well. It's said that in India, to win, any company or any person needs to master ABCD, which is A for astrology, B for Bollywood, C for cricket, and D for divinity. And if you use the same framework, for us, the way we thought about this was A, how can we be truly accessible? And so we put the inclusion lens there. B is sort of be everywhere, because ultimately payments a two-sided coin. C is for very deep customer focus, and D is really about delivering on promise, right? So I think if you just take these four lens filters, if you will, that's what it takes for us to build a business and a user base and more in this space, and indeed in most businesses, right? And let me get into a little bit of depth in each one of them. Happy to take any questions thereafter. But from an accessibility perspective, look, it's very important. The beauty of what we are doing here is that payments is not just it is not just a kind of top 7 cities phenomenon, if you will, right? Like in India, and usually they think of India 1, 2, and 3. Payments is now Bharat, and it's kind of everywhere. So really figuring out how we do that and how we can be everywhere, sort of just from an inclusion perspective, is very, very critical. And so a majority of our users are actually outside the top 7 cities, right? Is like a very, very good indicator of that. But as we build on that, we all recognize that payments is a two-sided ecosystem. It's also not just about having users, but you also want to have places to pay. So you have to be everywhere, right? And I think that's an area we've kind of really doubled down on over the last 18 odd months. And, both Ashneer and Ram know far more about that space, but, really the building those places to pay is incredibly critical, so that it kind of just creates that virtuous cycle, if you will. And just from a customer focus angle, which is kind of like the seed that I was talking about, there's a bunch of things that we have done that we think shows us sort of to be very, very local, very focused on, what India needs. We've done Rangoli in the past. We've done a Go India game that we did last year around Diwali. So there's a lot of, I think, things that we do just to ensure that customers know we're thinking about them, speak to them at the time of relevance. And also we're building on different use cases so that, look, ultimately what customers really want, what users really want is choice, right? Like they want the option of choice. And so the work that we're doing with Visa and a set of issuers around tokenized cards, and what we're doing on the Ace credit cards with Axis and Visa again, shows that it's about offering those options as well, and continuing on that deep customer focus. And then look, ultimately all of this just falls flat on its face if you can't deliver on your promise.
Yeah.
Right. So I think this is the one area that I think we all collectively as an ecosystem have to do still so much work on, just in the area of reliability and sort of fighting fraud. I think it's incredibly critical as an ecosystem, banks, NPCI, all of us players, right, networks and rails and others, all come together to ensure that, look, we're at basically near flawless levels of reliability, and then that there is zero fraud, and as that happens, as you start to deliver on all of those promises that you make, that's when, all of these things start to come together, customer growth starts to happen. So ultimately, look, it's about, being available to everyone, being present everywhere, deep customer focus, and then delivering on promise.
Thanks, Sajid. And I think the ABCD, as you started with, is really powerful. I think all of us grew up learning ABCD in the payment space. Again, as you have said, there is ABCD, and customers being at the center of it is really there. And I think the point which you made about looking at what the Indian customer is wanting and some of the initiatives which you have done, I think there would be strategies around it, and the promise, to make sure that the one delivers to the promise is really important. I would probably, go to Mr. Ramachandran, to you. You have been in the payment space, I think, from the time I first had a debit card or a credit card in my hand, maybe before that, actually, let me say. And you have been seeing how the entire environment is moving, and, have had a razor sharp focus on what customers are looking for and how one can deliver. So I would ask the same question to you too, and would like to have your thoughts to be shared with the audience, and some, examples, if you please. Thanks.
Yeah, so I would say that making payments ubiquitous and making payments frictionless are the two pivots, apart from the third important pivot, which Sajid rightly mentioned, which is making payments secure, right? Why ubiquitous? Because whether it's India A or India B or, Bharat or whichever is the latest acronym, it has to be sort of democratized and not only available to a particular subset of customers, right? That's sort of ubiquity. And the reach of telecom and the reach of video in particular has shown us that it can spread across socio and economic sort of strata. The second is frictionless. Let's remember that in India, our biggest, person we're fighting against is cultural propensity to use cash and to accept cash and to pay by cash.
Yeah.
And therefore, rather than buck the trend, I would submit that payments have to be as convenient, as seamless, as interoperable, as smooth as giving a 100 rupee note to a shopkeeper and the shopkeeper sort of receiving it. That's the sort of gold standard that we have to go to. And number three is in terms of security, right? And I'll talk a little bit about it later, but I would say that security, because India is taking baby steps towards payment, right? Only 15% of India is sort of digitized in the personal consumption expenditure space. Consequently, anywhere where we're taking baby steps, we don't want an I told you so if something goes belly up and customers hastily retreat back to their erstwhile habits of using cash. So it's incumbent upon, but you're going to see several more kinks to the J curve going forward, because this is a decadal secular growth opportunity for consumer growth in India in payments.
Thanks, Mr. Arjun. And I think the way you have articulated also is really easy to understand. It has to be ubiquitous. That's how the participants, customers, and merchants will participate. It has to be really frictionless. And the 100 rupee example is something which I also often take. So it is not just about making the payment when you're buying the good, but to make sure that 100 rupee reaches the bank account of the supplier, and the supplier can use it without any concern that it will not be there. So very well said as an example to explain that. And I think one of the point which you raised there is around the ubiquitousness and merchants really come into play there. Of course, there is payment on P2P where remittances are happening, but a lot of payments are around fulfillment of the payment for any product or service which a customer buys, and that's where the merchant acceptance becomes really important. And while from my lens, I see it is growing, and I think India as a country needs much more. And a lot of innovative stuff also has happened on that, and some of it, people like you who are in the panel have done that. So no better person to ask, people like you. And Sajid, maybe if I can ask you the same question on the merchant acceptance, what's happening in India, what are some of the newer things which the industry is focusing on, anything which you believe as an ecosystem one needs to do to really take the merchant acceptance of digital payments through across the country. So any insights if you could share would be really useful to us, the audience. Thanks.
It's a very critical question. I touched upon the fact that indeed payments and is a two-sided coin. Look, let's start with the basics, right? I think the first thing you want is to have a network in place, right? Like, and by network, I meant just like acceptance everywhere. Ram also touched upon that in his opening remarks as well. And, I think there is some, it depends on which source you listen to, but I think RBI kind of says there's upwards of over 20 million now QR, codes that are around in the country. There's about, I think, 5 million POS machines, right? And counting. Now, I think it's critical that we get like all of these merchants, regardless of size, scale, location, we need to be able to find them and bring them online, right? And by connecting them. And I think whilst to some extent you'll see high visibility in these tiers 1 to 3 cities, but I think tiers 3, 4, 5, 6, 4, 5, 6, which is kind of what the PIDF is meant to drive, seeks to address that. So number one is pan-India universal sort of at least adoption of any one form. Because look, you want to build the highway first, right? Like, and that's what really this is about. So number one, I think there's still a lot of work to be done there, and I view this as less about. It shouldn't be a battle for space, but it should be a battle for like bringing these merchants online, right? Like, and it's not going to be easy to do. It takes a lot of investments. We've invested in this space a lot. Others, both Ram, Ashni, have also done that a fair bit. So that's, I think the number one place that I'd start from. And then you want to start building on top of that, right? Like, what are the other kind of services that the merchants will need? And how do we ensure that transactions and all of those things happen reliably and securely? And there's still a lot of work that needs to be done in that area by the ecosystem. So, I genuinely believe in start with the basics, have strong foundations. You can build anything you want on top of, very strong foundations, but having presence everywhere, having reliable and secure and fast transactions are the two kind of corners. But I see that Ashni is also joined back, and no doubt, Ram will also have some thoughts as well. So let me pause.
Thanks, Rajit. And I think what you're saying is right, that this is a highway which has to be built, and it has to be super reliable so that merchants really are able to be onboarded. And I also believe it has to be super simple for them. Maybe I'll pose the same question to Mr. Ramchandran, to you. You have been again driving the built of ecosystem for ages. Visa has been doing that. So your thoughts in the Indian context on merchant acceptance and what is needed and some things which have already been done.
Payments is a two-sided network, correct? And the consumer adoption side has always been the more fashionable side of the house, right? Where where all the dancing and all the activity takes place. But the hard yards is actually where the acceptance infrastructure needs to be built, because payments are only as relevant to a customer as, if you can step out of house and use it everywhere. If you can only use it in pockets, then by definition, payments are not very useful. So it has to be useful for everyone, for everywhere, right? So that's how payments acceptance infrastructure needs to be built. And when you compare ourselves to some comparable countries, let's take Russia. So per 100,000 citizens, Russia has probably about 2,000 terminals or merchants. China and Brazil have between 3 and 3,500 per 100,000 citizens. India still has 500, right? So we have 8x, 10x to go, even to catch up to countries like Brazil and China. Never mind catch up with countries like the US or UK. And in that regard, so many of the efforts that players are making, whether it's established acquirers or new players or fintechs, is admirable. And I think the government and RBI is seized of it. I think the Payment Infrastructure Development Fund, or the PIDF, is one of the most exciting developments to come out of the RBI for payments in recent times, with an avowed sort of goal of 30 million merchants, right? Which is a large and ambitious goal. But we need a little bit of ambition if we have to pave the acceptance network. And by the way, this is also the first time probably, Kunal, you may want to do some research, but I think, to the best of my knowledge, this is the first time that a regulator is also contributing to the fund. Apart from payment system ecosystem participants contributing to the fund, which is, like Sajid mentioned, towards tier 5 and tier 6, towards northeastern places, etc. And we need many more such innovative mechanisms in order for the acceptance network to grow. But this is absolutely foundational in terms of growing of electronic digital payments in the country.
Thanks. And I think what you're saying is right, that the regulators paying for the development process in this manner has not been many times there. India has been known, so in telecom also we had seen the USOF, Universal Service Obligation Fund, to develop the infrastructure. And I'm also equally excited that with this fund being there, and with all of you really trying to make sure that we further accelerate, there is a bright future out there from a payment side. That brings me towards my last question. And as it is said in Stratton's law, which was after a gentleman who actually had robbery as his business, he was asked that, why do you rob banks? And he said, I rob banks because that's where the money is. And in today's environment, actually money is not there in a bank in a typical manner of a branch, but it's all in the digital ecosystem. And payments, while it is a fabulous thing, digital payments to enable business, it also has its own degree of risks coming in. So from a cybersecurity and risk side, how do you see payments developing? There are lots of challenges which we are still seeing, and and I know organizations like yours, along with others, are doing a lot of work there. So I would like to hear your thoughts. Maybe I'll start with Mr. Ramchandran, you first, on the cybersecurity elements, and also if you could touch upon that newer technologies are coming in. So we are seeing voice-enabled payment interactions with customers. So how these new technologies will also be handled from this angle. So over to you for your thoughts and insights.
Thanks, I'm happy to do that. Firstly, like I said on cybersecurity at the beginning, we have to recognize that the sender of the payment and the receiver of the payment both are in their nascent stages of receiving a payment. So a fraud can happen at both ends, right? I don't know how to pay, so somebody is exploiting that, getting my details and sort of impersonating me to make the payment. And similarly, somebody is fooling the merchant or the sort of receiver of the payments. And we have to understand that in 2021, it's no longer sort of two malevolent kids sitting in a garage trying to sort of fraud the system. These are very large, very well-funded, deep pocket actors who are focusing on frauding the electronic payments infrastructure. Sometimes there are nation states involved in it. That's the scary depth to which the fraud exists. And therefore, we have to keep customers transparent to all of this and make sure that we build deep and also build walls which are high enough so sort of fraudsters cannot penetrate. And I can tell you from Visa's experience, it is a 24/7, 365 kind of job to erect thicker, deeper, more redundant sort of firewalls, and be more proactive than sort of reactive. And the second part of the security is, what do you do with the customer data itself? And customer data is a very, very touchy point anywhere in the globe today, right? Sovereigns are worried about it. People like you and me are worried about it, et cetera, et cetera. And now, so technologies like, for example, tokenization, which actually devalues customer data, right? And sort of encrypts it and devalues it. So even if it were to fall into the wrong hands, it becomes meaningless. So I believe that tokenization has to become ubiquitous. And segueing into what you said about newer technologies like IoT, at Visa, we think there'll be 20 to 25 billion connected devices on the planet, apart from 7 or 8 billion mobile phones. And so if those connected devices are going to talk to each other and at some level make payments, we have to engender a level of security which is embedded into the security by design and security by architecture into the sort of IoT scheme of things. I'll stop there, and maybe Sajid has a point of view as well.
Thanks. Yeah, Sajid, what do you for your thoughts on this area?
No, I mean, just generally echo the points that Ram had made. As you know, I mean, this is an area that is incredibly foundational to what we do. And Google's very focused on this area. And I think one of the things that our engineers have done is an incredible job of bringing to bear AI and ML learnings to sort of be able to find the right signals, be able to distinguish, what's genuine versus what is not. However, as Ram pointed out, this is not a static kind of target, if you will. Neither is it, it's moving. And anytime we do something, one of the interesting things that we've discovered, I use the word interesting, but it's worrying also, is that these fraud vectors, they just keep changing.
Yeah.
Today you disable something, next thing they get smarter. And also the other thing is, it's very hard, no matter how hard you try from an AI, ML, all of these other, two factors and all of that stuff, it makes it very hard if social engineering keeps happening, right? So I think the user education bit, along with everything else that engineers can do and will do, is very, very critical. The awareness that users need to have about, the things that they should not share is very, very critical. And I think that is, there's still some work that we need to do on that, and we need to continually do that work, because look, digital payments will only grow, and there'll be more people who come on different kind of rails that are digital, and it's very, very critical for us to continue that education.
Thanks, Sajid. And from my view, I think India as a society and culture is of openness. We are very, we have people who share about our backgrounds, our personal information very, very easily. So the problem is really more there. And this is really an area where now it's not about people sitting in garages, Ramchandra, you were saying. It's people who really have a business. And these people, when they run this business of illegitimate businesses, they don't have to fear about any regulations or anything. And they are keep on hunting on where they can make money about. So we believe it's a journey, and I think the point which you mentioned, right from making it more deeper controls, as well as newer technologies like AI, ML coming in to handle the security and customer education, I think that journey has to continue. But thanks for sharing your insights, and coming from you, these are real things which payment industry needs to evolving. I think we are also coming to the end of our session. I would just close it by saying thank you to both of you. And I think the ABCD of the payment which you started with, Sajid, and the elements on ubiquitousness and frictionless environment, and of course cybersecurity, which you alluded to, Ram and Sajid both, they are really interesting, and I hope the audience benefited from it. I would again thank you, both of you, on behalf of the audience and from my side also. Thanks a lot. Thank you.
Thank you. Thank you so much.
Thank you all.
Thank you, everyone.
On day one of the ET India Inc. boardroom, we had a panel discussion on building Digital Bharat. Today, we have a follow-on to that session, a discussion on soft POS and offline POS as a catalyst to building Digital Bharat. The discussion will focus on the impact of offline and soft POS in remote and rural areas. Panelists will speak about the benefits, global trends, possibilities for offline transactions, and the security offered to merchants and cardholders.
Good evening, everybody. My name is Nilesh Gupta. I head RuPay Card Acceptance for POS and Ecom business at NPCI. Today we have gathered with this panel discussion on the topic of soft POS and offline POS to play the catalyst role for building Digital Bharat. This is with the theme that we take 5 million POS terminals that we have today to 50 million POS acceptance touchpoints. For this panel discussion, we have our esteemed panelists. We have Mr. Mohit Bedi, who's the SVP and Business Head Acquiring and Commercial Payments Business at Axis Bank. We have Sanjeev Kumar, who's the CTO at Pine Labs. We have Mr. Vishal Maru, who's the Senior Vice President at Worldline. And we have Mr. Tata Venugopal, who's the GM Union Bank of India. So thank you everybody for your presence today, this evening. We will start with our first discussion point. So we all know today, when we look at the number of POS terminals that has grown over the period of last 4 years from where it used to be. We have seen a clear growth of 1.4 million terminals, which used to be in the year 2016, growing to almost 5 million POS terminals as we speak now. So while we have covered this much of journey, we also know for the remote and rural areas, there are still limited connectivity and less acceptability of digital transactions. So my question is to Mohit, how do you think there will be an impact of this offline functionality that RBI has permitted now on the retail side, as well as coupled with the soft POS solution which is prevailing now, will create an impact on either to help the economy in these areas, or to enhance the acceptability, or to enhance the consumer experience?
First of all, thanks Nilesh for having me in the panel. So at Axis Bank, we service close to 6 cities in India as far as acquiring is concerned. I don't know if we know which these 1600 names of these 1600 cities becomes a tough task. So we travel a lot, and we've seen that the two biggest issues as deeper you go into India is primarily around the cost of the terminal or expenses that these merchants bear. And second, obviously, is the connectivity. So when you, in fact, we powered the Hornbill Festival in Northeast, and we had gone there, and we had powered the entire payments infrastructure for the police over there. Now, the biggest challenge over there we were facing was around connectivity, because there is no telecom network that gives you the kind of support that Northeast region specifically requires. And secondly, when you tell them that, okay, why don't you take a 4G or a Wi-Fi terminal, the more functionalities or more kind of connectivity that are brought onto the terminal, the more expensive it becomes. So for example, our Android terminal is obviously more expensive than GPRS terminal.
Right.
Now, what happens with the soft POS is, one, your form factor becomes your own phone, correct? Which means it becomes affordable. Right. And secondly, you are used to the interface, right? You are used to Android interface, so it becomes easier to use. So soft POS for us, we look at it as a differentiator in terms of form factor, in terms of adaptability of the product. And not only does it help in adaptability, because your phone becomes your terminal, you can load onto it a lot of other features. Where does the guideline now the second piece, which was on offline payments, what happens is it takes care of the connectivity issues. Now, when you go to festivals or cultural places, your ticket size are not very large, right? You have small ticket sizes, etc.
Right.
So now imagine you club the soft POS functionality with offline payments. You can do small ticket transactions and then do the authorizations later. It is like a win-win situation as we go deeper into India. Now, remember this is clear. These are clear and present issues that as we go deeper into India you face. And this is like a icing on the cake when you have both these functionalities as far as acquiring setup is concerned.
Absolutely, absolutely. Well said, Mohit. So with this perspective, it is also important to talk about some of the security aspect of both the soft POS as well as the offline that we have been given the permission from RBI. So Sanjeev, coming to you, how do you see the security features and how do you compare this with the global trend on both soft POS side as well as on the offline side?
Yeah, thanks, Nilesh. Naturally, it being the Android phone, right? The soft POS is for the Android phone having NFC. The attack surface increases. So typically, if you compare a terminal which you buy or terminal which you deploy, those terminals are, they have been, hardened in terms of the hardware components. They have a separate CPU, separate RAM, separate secure area, what you call as TRSM, right? And those TRSM area, you have the SRAID. So those devices are hardened using PCI PTS, PCI POI. Naturally, these things are not factored in the phone, right? So there could be a fear that these phones, when you launch something like soft POS for acceptance of card, where did all those principles go, which was on which these specialized devices were made? But there are a few things which Android has done, especially Android 8.0 Oreo and above, which gives you confidence that over the period of time, if we study the confidence in the software based security will increase. So the moment you remove security aspect, which was pretty much hardware driven, you got to do a lot more on the software side to make things secure. So the way this soft POS thing has been organized and the soft POS has been designed, you need to have various attestation levels, right? Attestation in the sense that you have got the Google safety net to define that the device is right or not. Then you possibly have a next level in which Google gives you the trust chain, that trust my device. Then you can do device fingerprinting. Then you can do app signing. Then you can do remote key injection. So you got to do a lot more coding. You got to make your device a lot more secure, because the work done is same. The hardware level support has gone down to make it generic. But the benefit is that the more you cover these, the benefit you get is that you have that level of security which a normal terminal has, and it is now over the air. Over the air, you can push the app on the phones. Suddenly, it becomes available. And now, statistically speaking, pretty much close to 60 to 70% transactions are less than 2,000 rupees that do not require PIN. So the ticket size by the risk has gone down, and now it is a contactless transaction by tap. So it is pretty much the risk has also gone down with the strong filters like Google safety net, device fingerprinting, side channel attacks, like don't allow cameras to be opened when the card is being scanned. So all those things. So it's like the burden on the software has increased, but for all good. You have the app made, you have the app transmitted over the air, and from the word go, this is one can onboarding can happen, and transaction can happen, payouts can happen, and with this happening, it will be such a light touch model that spread what you have said 5 million to 50 million suddenly looks feasible.
Absolutely. So where we heard from Mohit on the fact that it really finds its use case in general adaptability from the merchant side. You have also highlighted the fact that while there is some hard work on the player side to put together the application and make it secure, the kind of benefit that it provides for the long run is enormous. So from there, let's talk about and continue talk on the use cases. And coming to Vishal, so how do you see this whole offline thing and soft pause from the speed of transaction perspective? And how can it amplify the number of use case which may exist or may not exist, but it will get amplified further with soft pause and offline solution coming in together?
First of all, thanks Nilesh for inviting me. So Sanjeev spoke about security, Mohit spoke about the use cases and the ample opportunity available within India. Now there are very clearly two important aspects to the soft pause. One is that there is always a very high cost of capex, and second is that the cost of execution and rollout. What happens with soft pause is that you actually get away with the cost of the terminal. So it's your own device. User merchant has its own device, and on its own device, he can actually download the application and start using the application for accepting transactions. So one is very clearly the cost of device which gets away. Second is in terms of the execution. Now, like 1600 cities which Mohit spoke about, rolling out, sending out terminals, managing the application on the terminals, obviously it is a hell of a job. So when it is soft pause, you can actually push the application over the air, and there are upgrades which can happen very regularly. So I think very clearly these two big problems are being sorted out by a soft pause, and which also means that the application which people have developed now in the industry also covers 4 important elements or SKUs of payments, which is tap on phone, which is UPI, which is QR code, and the last one is SMS and email invoicing. So I think from a speed point of view, from the rollout execution point of view, there is much more easy way to deliver the things, and that's what is soft pause. Then also look at the lower of the pyramid merchants, where these merchants are not doing as much transaction as required for us to make an substantial ROI. There, soft pause is a very super business case because merchant doesn't have to pay high rent, and at the same time, you don't really have to invest into managing that equipment to the extent which is required. So I think soft pause is a very clear case of reducing the cost, managing the speed, and also rolling out the more complex and sophisticated applications on the terminal, on the mobile application.
Right. So Vishal, if you can also speak about some of the offline opportunities and the use cases that it can convert for us, which may be existing or may not be there today, but it can definitely form a large part of our transaction sets in the near future.
So Nilesh, offline is a very interesting case from two standpoints. One is very clearly we have still issues in terms of the connectivity. If the number are right, then we still face almost about 3 to 4% of the transactions getting dropped out because of the connectivity issue. So very clearly, there is a connectivity issue. When you go down in the remote area, you find problems to accept transaction. I think very clearly the offline transaction will address that problem. And the other thing is when it comes to the new segments which should be brought on to the board from an acquiring standpoint or for the digital payment standpoint, very clearly you have use cases like toll, parking, transit, and quick checkout. So I think very clearly this offline transaction will help manage the 3 or 4% loss or the loss in the transaction. At the same time, it will help us get more merchant segments. Now we have been talking, the entire industry is talking about 5 to 50 million, and it cannot be achieved until unless we actually get this kind of merchants which are into transit, parking, toll, and the quick checkout, maybe the fares, state fares, which Mohit spoke about. Those merchants we have to brought into our fold. Those merchants have to be brought into our fold, and I think soft pause will really play a major role there.
Right.
Offline transaction as well.
Right. So Vishal, on one last point that I just wanted to take your views on is the fact that offline will also kind of take away the load which may be there at the bank system to be able to manage the authentication piece or the manage authorization piece every single time that the transaction is coming online. So as we grow, as we have seen in the last 3-4 years time, the kind of scale that digital transactions have gained, if we were to look at the near future or midterm future, may not be the systems which are available today with the banks would be able to sustain that kind of scale. So it would be good idea, to take away some part of the load in terms of offline transactions and materialize that outside the banking system. So do you think offline solution, the way we have positioned it, will facilitate that and will kind of take away that load from the banking ecosystem?
Yeah, so now today the offline is more on a pilot base, so it will continue for I think till March 2021. But
True.
very clearly, it will also give an opportunity for the banks to offload their investment on their hardware and infrastructure. Because very clearly, if we have to grow from 5 million to 50 million, we have to hive off some of the investments onto the systems like offline, and especially for the use cases which are very much clearly evident for the offline cases. So I very clearly see that there is an advantage in having the offline transactions, and which will help the banks to offload some of their investment onto the systems which are not really required to be there in terms of the online side. So very,
right.
you are right.
Right. Thanks, Vishal. So, Mr. Tataji, I'll come to you now, and let's talk about some of the benefits that the small ticket size transactions, which will happen on the soft POS and offline kind of environment, will create the need for for all of us.
Yeah. Thanks, Nilesh, for inviting me. See, we should see here three aspects are there. One is the soft POS, which is practically our mobile phones will become a soft POS. That physical POS is no more required.
True.
Second is the contactless payment, which is the need of the time. In this COVID era, whatever things are happening, this is the need. Third, we see it is the offline payments. Correct? See, in the offline, what will happen? This network dependency will come down. There is no need of the transaction hitting the bank server and giving the authorization, authentication, all these things will not be required. Now we see the other aspect. Now it's network, everything is fine in tier 1, tier 2 cities. But when we go towards the digital India, the real things lies in the tier 4, tier 5 cities or tier 3, tier 4 cities. That network, this infrastructure, all these things are not there. So all these things really add to the value. First, there is no cost of a separate owning a POS machine. Even my mobile phone will become a POS. That acceptance will come. And further, if you see the number of transactions which are taking place now, what I feel nearly 80% of transactions are less than 2,000 rupees, individual level.
Right.
So here the use cases comes. All these things, even the Reserve Bank has permitted, our regulator has permitted up to 2,000 rupees, you can go for the contactless.
Right.
These are the advantages. First. Second, if you see, there are so many instances where people are exchanging the money, but that is not getting recorded. Like I'm paying my parking fees, that is not getting recorded anywhere. So small kirana shops, that is not getting recorded. Once we go for that, all these things will be recorded. Maybe in the down the line, that credit history will be built. Once that credit history will be built, banks can give the credit to them also. Like we can see PM Swanidhi, the glaring example. It is a very successful scheme where street vendors are getting the support from the banks. So this is a really good concept and we have to go with that. These are my EA. And third and last point, success rate is going to increase once we go for the offline mode, contactless. Naturally, success is going to increase. And once the ecosystem increases with the success rate, the reliability and the basic confidence of the users will be built in. Yeah.
True. Well said. So with this, let me just bring the context back to Mohit, you and with respect to some of the benefits that the cardholder and the merchants will get. Let's talk about the liability part of it. So what is your view on the liability, the limited liability, which as per RBI pilot approval that they have given, they expect that the limited liability is with the consumer. So what are your views on that?
So I think Sanjeev also alluded to the fact earlier that since the transaction and ticket size is lower, and as Vishal mentioned, the pilot is till March, you'll get more reads from the pilot. And obviously, we are trying to experiment and see how the adoption picks up and what is happening. But considering that the ticket size is small, I think, and the benefits, just realize you are not only making the whole transaction digital, you are making it touchless, right? In these times, you are moving to a contactless transaction. I've seen a lot of instances where people don't want to touch paper or accept paper, whether it is in form of cash or a bill. So there is a convenience around it, and the pilot will tell us what is the adoption rate, and second is it will tell us whether the consumer is okay with the benefit and convenience that this brings in. Are they willing to take that liability? And see, the liability, there are a lot of players involved in the ecosystem, right? And everybody is gunning for the fact that this takes up the entire agenda of digital and contactless transaction. So we are just hoping and that the results are encouraging enough that we are the liability side of it doesn't. I mean, the liability side of it is not as big a concern for the benefits that this entire ecosystem will bring in.
Absolutely, absolutely.
Yeah.
So we can definitely weigh this limited liability clause that RBI has given us with respect to the benefits that it will bring for the larger cause.
See, ultimately, the system will evolve, ecosystem will evolve, people will come to know, and that's what pilots are for, right? And sooner or later, you will have brand ambassadors, not only in terms of banks, you'll have brand ambassadors in terms of merchants also.
Absolutely.
So we are banking on the fact that the entire ecosystem adopts it and also encourages people to take it. So it is just about training and the pilot being successful. So let's see. We are fingers crossed. I hope it takes off.
Yes. So coming to Vishal, you what are your views on the reliability and the convenience that these kind of payment facility brings to the consumers?
Talking about the offline first. If you look at the offline transactions, the ticket size as of now is limited to 200. So, which obviously means that the exposure is very limited. Now, today, if you look at the transaction, an NFC transaction typically takes almost about 5 seconds to 10 seconds or 11 seconds for a transaction to go through. Now, this will really come down to 1 second, which is an experience in itself.
Absolutely.
Then you look at the use case. Now, today, if I am at a quick checkout restaurant, within a second, I can do a transaction and then just move on. If I am in a transit, taking a transit in a bus, I can do a transaction within a second. And I think that's the experience which will count. The only thing is that after the experiment, we'll have to realize and figure out whether this 200 really makes sense or it should actually come down to a level of 2000, which I think in the transit case, it is still allowed, the offline transaction to 2000. So we'll have to see whether what is the right ticket size and what is the right amount of risk mitigations players are able to put in. Offline transaction obviously will call for some bit of trouble in terms of risk or also in terms of settlement. But I think in this 5 or 6 months, we'll have to figure out and see how we put our process in place and figure out that there is no inconvenience to a customer as well as to the merchant. So if that is something we are able to balance off, it's going to be much more beneficial for us. On the soft POS, I believe it's completely convenience from a merchant standpoint because it is bring your own device, do it yourself. So a customer, a merchant can easily get onto a mobile application and download application and be a merchant on the same day itself. So that's a big convenience. Secondly, the soft POS will record all the transactions which you can see on the mobile application. So which means that there is a lot of convenience on the merchant side.
Absolutely.
Tap on phone will bring a lot of convenience to the cardholder because of the COVID. Everybody wants a contactless payment, and tap on phone will actually help us achieve that objective. So it is convenience, it is speed, it is risk-free, secured, and obviously it is much more cheaper. So I think it has all the elements which makes a product successful in a payment environment. So
absolutely.
Offline and soft POS both should be really growing faster.
Right, Vishal. So Sanjeev, coming to you, can we just hear your views on how this whole soft POS and offline thing will bring the wider acceptability with the retail merchants? Mohit already spoke about that point in his topic, but what are your views on this? How will it bring wider acceptance?
See, there are two parts to it, right? So one is offline below 200, and other is soft POS, right? So offline below 200, I think a lot has been talked here, and all true and valid, because this less than 200, there is no load on the network. There is no additional load on the banking switch. The transaction, it is literally as you say, that 300 millisecond the contactless read has to happen. Worst case is 1 second for a transaction, which is literally 5 to 6 times or more efficient than what you have on a normal card. And finding it hard to say, but at least 1 second against 25 to 30 seconds the transactions on the QR it takes, right? So that's the kind of efficiency we are gunning at, without impacting saving the telco load, saving the bank switch load. It's all win-win, and the risk is minimal. Risk is very minimal, right? 200 rupees transaction is the risk is kind of no risk. Now coming to the soft POS side of it, see, lot of digital transactions will come owing to this soft POS thing, and owing to this offline thing, and transactions which were otherwise cash will turn into a card, or will turn into this thing, offline card. Right. Now with the soft POS coming, the merchants who were hesitant to accept the digital payments, that where to keep the terminal, where to put the charging slot, keep the terminal charged, out of 100 transactions I do only 3-4 give me card. Owing to these times, especially these COVID times, the card holders, the people want it all touchless, either it is through QR or through the card, and with contactless coming, and that too offline, and that too on a merchant phone. I think it's all everything is coming together to make it a hit, right? So acceptance no doubt will increase. I think only catch point here is that in terms of penetration of contactless terminals since 2016, every terminal is contactless. A lot of phones are having NFC support. Acceptance wide, I'm not worried. One of the panelists here was saying that we have the brand ambassador from the bank, it will move to the merchants as well. I feel that we have to add a third actor into it, that the cards issued should default be contactless as well, of course with a limit, and to manage the risk. The problem here is, so let me state one problem also, that the cards have to be issued more and more which are contactless in nature. Of course, you put a limit to minimize the risk, and those limits are well placed, right? But if that happens, then there is a sudden growth anyway in the contactless transaction. In the every month you have the progression happening. Absolutely. From 5% to now already 17%, 18% transactions are contactless in nature, right? I think it will reach a tipping point or a saturation point where it will not increase, because the issued base is not having the contactless, or even if it is having, enablement is not done. But when that happens, the intersection will be so wide that it will be win-win for everybody. That you will have the merchants having their normal phone meeting their average ticket size. Half the transaction are not even requiring SIM real time. Bank system not getting loaded, and then you have the customers coming mostly tap and pay. They are feeling safe in the payment. They don't even have to hand over the card to someone else. So that's again the added safety, not owing to COVID, but the comfort that my card has not left my hand. That's a big thing, by the way. So all those things will add together. As Vishal was saying, that let's wait for the pilot to happen. Fingers crossed. But if we do mathematical calculations, things should not go any wrong from here.
Absolutely. We all are having the fingers crossed, and we are all hoping that by 31st March 2021, we will have a good story to look at.
Absolutely. Agree.
Yeah. So, Mr. Tata, let me just take the next question to you. with respect to the initial investment and the installation cost, which are typically associated with any physical device? How will it get impacted with soft POS and offline coming in?
Here I would like to say the acceptance of soft POS, it has got few dimensions. One thing is the ownership. Flexibility is there. And second, that independence you are having. See, you can do it yourself. What I understand, I no need of depending on some engineer or someone, they will come and they will install the POS. All these things are not there.
True.
You yourself can configure it. And what I understand, maybe maximum 30 minutes or 45 minutes, you are ready to do the business.
Absolutely.
So that is the flexibility and that is the ease of doing the things.
Absolutely.
And second, no extra investment. Your smartphone is now your POS. You are a merchant acquirer the moment you are having a smartphone. So that is a very good concept. It will, so no initial investment, extra investment is there. No installation issues are there. And further, whatever transactions are taking place, you can see in your e-khata or e-ledger. We can tell in the e-ledger. So that gives the confidence also. Yes, I have received the payment. And second, if you say offline, that a network dependency is not there. Earlier, my colleagues were also telling it. So that is also having an added advantage.
Absolutely. Absolutely. Yeah. Great. So, great. All the discussion points that we have had and all the responses that we have had from you does gives us the confidence that soft POS and offline POS do have the capability to play that catalyst role to make Digital Bharat dream true and take the 5 million POS acceptance what we have today to 50 million POS acceptance touch points indeed. Yeah. So thanks everybody for your time and your views. We have completed the session. Thank you very much.
Coming up is a segment where we celebrate contactless payment experiences with various features of RuPay 2.0 that highlight RuPay's continuous innovations in the payment ecosystem.
Hello everyone, I am Nishant Gaurav and I am here to introduce you all to the RuPay POS solution. Over the past few years, there has been huge surge to have a deviceless solution for the merchant who have been declining to invest on the physical hardware for payment acceptance. Also, the mPOS market has hit its growth stride with even the largest of retailers adopting the mobile-based technology to help update their customer experience and improve satisfaction. To magnify merchant acceptance into upcoming segment, RuPay had been working on to derive new innovation through Tap and Phone RuPay POS solution, which allows merchant to accept payment from a RuPay contactless cards directly on their NFC-enabled mobile devices via software-based payment application with no need for any additional connected hardware. Making Tap and Phone work, it just need to enable your NFC on the mobile device and then your mobile payment application can talk to the contactless card and then contactless transaction can happen. This Tap and Phone technology has the same functionality as the regular POS or mPOS for contactless payment acceptance. However, as the functionality can be directly enabled on the merchant mobile handsets, makes the product cheaper and thus eligible for large market penetration. Also, this solution being software-based can be clubbed with other payment mode like QR, UPI and other use cases, which provides merchant with increased payment acceptance capability in contactless mode. RuPay POS solution allows approved merchant to simply download a supported app and use their existing Android NFC-enabled mobile phone as a payment terminal. It supports Android 7 and above, which comes with trusted execution environment for securing key storage as well as your transaction data. RuPay SoftPOS will accept transaction up to 5,000 without any second factor authentication. Means you don't need to enter PIN or enter OTP to do this transaction on the SoftPOS. It supports contactless online as well as an offline transaction. It gives you a security where your data can be stored securely on the Android key storage mechanism. For mobile devices not having NFC capability, additional hardware can be added and then your phone can be used to do any contactless transaction. So now imagine by enabling this technology, even the remotest corner of the country can be linked to the digital payment revolution with RuPay POS. By enabling this method, small traders and shopkeepers can now easily be connected to card payment without any major investment in card machines or POS. RuPay POS changes the way merchants accept payment, thereby driving the sentiment with customer to pay using digital mode of payments. Let's hear what our bankers and payment partners have to say about RuPay POS solution.
We would now like to welcome Mr. Giri Kumar, MD and CEO of SBI Payment Services, to speak about the RuPay POS solution and how it will encourage small merchants to transition to a digital ecosystem, thus driving customer engagement.
Developing a robust merchant ecosystem is paramount to creating a digital highway in influencing customer adoption and driving customer experience and engagement. While person-to-merchant payments dominate the digital space, we believe that acceleration of digital adoption by micro and small merchants is a key success factor in realization of the vision of less cash society. The digital ecosystem in India is fast growing as we speak, but in most of the sectors, it is driven by the cash only. So Government of India is also pushing towards the less cash society by various initiatives and various incentives also. SBI Payments is working closely with all stakeholders, including NPCI, to support government's Digital India initiative, enabling small and medium merchants in semi-urban and rural centers. We are also enabling NCMC cards on our terminals to improve customer experience at the time of purchases. The recent RBI announcement allowing up to 5,000 rupees through Tap on Go has further given impetus to our initiatives. There is also a special focus on northeastern region where we are enabling our merchants with cash asset light merchant acquisition points. This will help the merchants to have a Tap on Go and the QR acceptance through their mobile phones also. We at SBI Payments, we have completely digitized the merchant journey from onboarding, transaction lifecycle and service management. We made things easier for the merchants by providing cost-effective asset-light acceptance infrastructure. This will enable the customers all across India to pay conveniently to the nearby Kirana store by just tapping the card on the merchant's mobile. We propose to onboard nearly 100,000 merchants in northeastern region through this asset-light infrastructure acceptance. We in SBI, we are totally committed to being the digital banker to every Indian. Thank you.
We would now like to welcome Mr. Rajiv Ahuja, ED of RBL Bank, to share his views on how RuPay POS solution is a game changer for millions of micro merchants to enable digital acceptance and thereby contributing to the Digital Bharat story.
Hi, it's my pleasure to be part of this ceremony and share briefly our views and experiences on SoftPOS, a very innovative instrument technology being propagated, implemented by NPCI and RBL Bank. SoftPOS for us is one of that potential disruptors, game-changing approach to democratize the acceptance of digital payments by small merchants. POS devices have been around for decades, but they have been expensive. They are a little bit too much for a small merchant to service on a monthly basis. SoftPOS, with the advent of a lot of smartphone and the usage by a large part of our population, actually makes the need for a POS redundant. Through the use of a soft POS, every merchant can become a digitally enabled merchant. They can accept payments, especially in this COVID times. They can become a major conduit for providing services to their consumers, many of whom are adopting digital means. We at RBL Bank are very proud to be part of NPCI's initiatives in rolling out soft POS, which we truly believe can change the dynamics for enlarging the acceptance of digital payments, digital transactions across India. India always needed something new, innovative, and game-changing to what has been a mainstay of the larger, more established global markets. Soft POS, in our view, is one such game changer which leverages the tailwind of digital consumption, which enables many millions of micro merchants to get engaged, get involved in the digital Bharat story. And NPCI and RBL Bank are very proud to be a part of that. Thank you so much.
We would now like to invite Mr. Amrish Rao, CEO of Pine Labs, to share his experience on how contactless payments have gained popularity for both merchants and the customers, especially in this age of social distancing.
The RuPay Soft POS converts a regular phone into a POS machine. All you need to do is download the app from the Android App Store, and a regular Android NFC phone can get converted into a POS machine. This is a very important step in digital payments for India. The small merchants of India have been greatly impacted through the COVID-19 days, and they are looking for cost-efficient ways in which they can accept digital payments. The RuPay Soft POS can certainly do so. The RuPay contactless card with the RuPay tokenized card and the RuPay Soft POS, we think will provide a significant fillip to digital payments in India. We at Pine Labs are very excited to partner with NPCI on this journey.
We would now like to welcome Mr. Anand Kumar Bajaj, founder and CEO of Pay Nearby, to hear his plans on how to fast-track merchant acceptance to adopt and deploy the RuPay POS solution.
I'm Anand from Pay Nearby, and I'm very, very delighted to share with you today that with the help of National Payment Corporation of India and RBL Bank, we have launched the Soft POS in India. And this is a momentous occasion where India will leapfrog into the new way of payment in a formless manner. The merchant enablement will become faster with this no cost, no device strategy, where with Pay Nearby app, all the merchants, the millions of them across the country, length and breadth, will be now empowered to receive a tap and pay based digital payments from a card, a credit card or a debit card. Thankfully, this stitches into the National Common Mobility Card, the NCMC strategy of the nation. And as a policy objective, we stand tall to help India pay digitally.
Let's see a demo how RuPay POS works.
भाई जी इसका बिल बना दीजिए।
$135।
ये लीजिए।
छुट्टा दीजिए मैम।
कार्ड चलेगा?
हाँ चलेगा।
मेरे पास रुपए कार्ड है।
हाँ एक्सेप्ट होता है।
ये। हो गया?
हाँ हो गया।
अरे ये तो बहुत आसान है।
आसान है।
थैंक यू।
वेलकम। মোবাইল POS ব্যৱহাৰ কৰিবলৈ খুব সহজ হয়। মাত্ৰ এটা এপছৰ জৰিয়তে আপোনাৰ মোবাইল POS মেচিন হৈ যাব। ইয়াত মই NFS টেকনিকৰ জৰিয়তে গ্ৰাহকৰ পৰা মই পেমেণ্ট ল'ব পাৰোঁ। কৰোনা মহামাৰীৰ পিছত আমি গ্ৰাহকৰ পৰা পাবলগীয়া প্ৰাপ্যটো কোনো স্পৰ্শ নোহোৱাকৈ আমি ল'ব পাৰিছোঁ। ইয়াৰ দ্বাৰা আমাৰ ব্যৱসায়টো বহুত বৃদ্ধি হৈছে। খুচুৰাৰো একো আপোনাৰ অসুবিধা নহয়। আমি পাবলগীয়া বা গ্ৰাহকে দিবলগীয়া পইচাখিনি চিধাই আমাৰ বেংক একাউণ্টত সোমাই যায়। মোবাইল পোছ ইনষ্টল আৰু ব্যৱহাৰ কৰা প্ৰক্ৰিয়াটো একেবাৰে সহজ, যাক আমি ইণ্টাৰনেটৰ সহায়ত ব্যৱহাৰ কৰিব পাৰোঁ। এইটো ব্যৱহাৰ কৰা একেবাৰে সহজ আৰু একেবাৰে সুৰক্ষিত হয়।
Hello everyone, I am Adarsh Sharma and I am here to introduce you all to the RuPay AutoPay feature. With the increased adoption of the subscription-based services, consumers are in a constant need to maintain payment information and schedules for a multitude of services. The question is, have you missed to renew your subscription to your favorite streaming website? Are you struggling with too many schedules to keep track of? This struggle has prompted a need for a solution to ease the part of making these regular payments with minimal efforts from the consumers. RuPay AutoPay provides consumers a seamless and convenient means to set up recurring payments across a variety of applications. Recurring payments are increasingly becoming an important part of the consumer requirement due to the fact that there is a good adoption and propagation of the subscription-based model in educational services, software services, music and video streaming, bill payments, financial investments, online health and fitness services. As more and more services from the physical world are going to be digitized, we will see the scope of the recurring payments increase exponentially. The AutoPay feature brings the customer centricity to the forefront and reduces the worry of missing a payment. While it provides the ease of setting up recurring payments, it enables the consumers to be always informed when their transactions are being processed through a pre and a post notification feature. Consumers can enable recurring payments across a variety of merchants and use cases based on their need through a simple one-time registration process using an OTP. During the registration process, a consumer can define the exact amount or the range of amount and the frequency, such as daily, weekly, monthly, or annually, with which they want their transactions to be processed. Upon registration, transactions will be processed by the merchant as per the amount and frequency set forth by the consumers. To keep the consumers informed of the payments, the consumers will receive a pre-transaction notification 24 hours ahead of the payment transaction and a post notification after the payment transaction has been processed. The pre and the post notifications provides the consumers with the comfort that their payments are processed as per their instructions. If a consumer wishes to discontinue or modify the registration, it is a simple process. Consumers can choose to do so on the merchant website, or they can alternatively log into the website mobile banking application of their bank and cancel or modify the recurring payments. So now, with RuPay AutoPay, plan your scheduled payments with ease and comfort that you deserve.
Good afternoon, everyone. I am Karan Prashar, and I am here to introduce you all to RuPay Contactless and Wearables. We at NPCI started our journey with a thought of making India a cashless society. NPCI has always been the forefront of innovation and payment technologies. RuPay Contactless is a marquee example of the innovation that has enhanced the consumer experience. It solves a trivial problem of digitizing payments in area of poor or no connectivity through its unique offering of
offline wallet and thereby enabling offline transactions. RuPay Contactless enhanced the experience of a transaction by enabling payments with a simple tap of a card. This is simplicity at its best. While payments were simplified through a tap, the challenges still exist in areas with no or poor connectivity, especially in places such as metro stations, underground parking lots, and remote areas. To address this, RuPay Contactless introduces an offline wallet that can be loaded and used for making offline payments. The offline wallet can be loaded using cash or through internet banking. Additionally, RuPay Contactless also supports service area on the card for merchants and operators to offer specific services such as monthly pass, loyalty points, and many more. Through the service area, the card provides usability beyond payments. For example, a university may decide to store student information in one of the service area. A merchant can offer reward points of his customer on the card. Such application makes the RuPay Contactless card more than just a payment card. Cards have always been the main form factor since the inception of contactless payments. But the evolving technology has provided opportunity for new form factors such as wearables to carve a space for themselves. Wearable technology have enabled devices such as smartwatches, wristband, jewelry, glasses, and clothing embedded with payment chips for supporting contactless payments. Wearables are able to perform contactless payment using NFC technology with a simple tap of a card. Wearables add to ease and comfort of making payments, especially reducing the need to carry a card or a wallet with you all the time. A payment-capable smartwatch or band is far more convenient for making a payment while you step out for your morning run than carrying a wallet. In another example, while entering a crowded metro station, a simple tap of your smartwatch is better than taking out the card from the wallet. The enhanced experience and convenience provided by the wearables for contactless payments do make a strong case for its wide adoption. Today, we are excited to announce that NPCI is introducing RuPay on the go. Fast, convenient, secure. Now let's hear from our bankers and partners on RuPay Contactless.
We would now like to welcome Mr. S.S. Mallikarjuna Rao, MD and CEO of Punjab National Bank, to share his views on digital payments adoption in India and how RuPay's contactless technology has paved the way for safer, quicker payment solution in our day-to-day lives.
Namaskar. In the last decade, we have seen good amount of growth in digital transactions in our country. While the country was embracing digital transactions ever since the Jan Dhan Yojana has been implemented, the impetus has come with the active role of National Payment Corporation of India. They have introduced many products like RuPay credit card, RuPay debit card, NACH, Aadhaar-enabled payment system, and UPI interface for facilitating various payment transactions. Particularly post-pandemic, when the entire country was adopting digital way of undertaking their banking transactions, UPI has become so handy that the volume has increased tremendously. With this kind of an initiative, NPCI in the days to come as well, I expect that they will work towards increasing the digital canvas of our country and also the digital volume in terms of transactions as well. We have also seen various products like National Common Mobility Card, contactless card being introduced by NPCI in furtherance of these kind of transactions. So best wishes to NPCI. Thank you.
We would like to invite Mr. Rajkiran Rai Ji, MD and CEO of Union Bank, to speak about the ecosystem shift from contact-based payment to contactless payments and how this has helped in the digital transformation journey.
It's a great privilege for India to have NPCI, National Payments Corporation of India, an umbrella organization for operating retail payments and settlement systems in India. I congratulate NPCI for initiating a shift from contact-based payment to contactless payments. There is a need to digitize payments with the vision of faster, convenient, and secure payment. Contactless payments is the future of payment industry in India and a journey towards digital India. Contactless payments have many use cases like withdrawal of cash at ATM, shopping at merchant locations, toll payments, transit systems, and many more. Union Bank of India will embrace the new technology of contactless payments of NPCI and will contribute towards becoming a less cash society. Thank you.
We would now like to welcome Ms. Padmaja Chunduru, MD and CEO of Indian Bank, to share her views on how RuPay contactless payments are the safest and most preferred mode of payment amongst the consumers.
NPCI has taken a leap ahead in terms of technology, security, and convenience. The RuPay contactless card has indeed emerged as the safest way of making payments. I congratulate the Managing Director and the entire team of NPCI for the success of this contactless card. This card is driving inclusion in remote areas because it does not depend on the connectivity and on the mobile or the internet network. This is a great opportunity for us, stakeholders involved in this payment ecosystem, to adopt this latest technology and completely go digital for daily small value transactions. Indian Bank has always been associated with NPCI in all its flagship programs, and I am proud to say that Indian Bank is the highest issuer of RuPay Platinum cards, with 95% of the bank's debit card under RuPay portfolio. I welcome everyone to enjoy this contactless, safe, and secure payment experience and be part of the future of digital India. Thank you. Congratulations.
We would now like to invite Mr. Sanjeev Moghe, EVP and Head Cards and Payments at Axis Bank, to speak about the bank's initiatives on driving the contactless wave to the end consumers.
At Axis Bank, we've always prided ourselves on being leaders in contactless space. A recent trend, which obviously has been fueled by COVID, is a significant growth in contactless transactions, given that these are far safer. There is no contact, you just tap the phone or your card and the transaction goes through. This is also obviously fueled by the recent change from RBI on increasing the cap from 2,000 to 5,000 for transactions without PIN. We are working very closely with NPCI to now take this to our terminals, and we have enabled close to 2 lakh terminals on these transactions for NPCI RuPay cards as well. We are also working with NPCI on enabling offline NCMC transactions. Along with all this, we are very proud to be pioneers of NCMC contactless transactions in the transit ecosystem with our Kochi Metro tie-up with KMRL. All of this makes us very bullish on the space of contactless, working together with NPCI on furthering this partnership between the two organizations and also taking contactless proposition to our customers.
We would now like to invite Mr. Manas Ranjan Biswal, Executive Director of Union Bank, to hear his thoughts on celebrating the new wave of digital India with RuPay contactless cards.
It is indeed a great occasion to witness NPCI launching its second wave of RuPay from contact-based payments to contactless payments. This shift was required to have convenience of payment by the customers, whether making payment in POS terminals, at toll plaza, or in transit systems like bus and metro. Speed is the essence of digital payments. And with contactless cards like credit cards, debit cards, and prepaid cards, the transaction time is going to be reduced by 30 to 40%. We at Union Bank of India are very much optimistic about the new initiative of NPCI and foresee quick adoption of technology by our customers, paving the way for digital India.
We would now like to invite Mr. S.K. Suri, Executive Director of Retail at Hindustan Petroleum Corporation Limited, to share his experience on HPCL's partnership with RuPay contactless technology at all petrol pumps to enable faster and convenient transactions.
HPCL is happy to partner with NPCI on this exciting journey of digitalizing payments in our country. We at HPCL, in collaboration with NPCI, have ensured that our network of over 17,000 retail outlets accepts RuPay cards. We are happy to note that the RuPay transactions are growing at more than 100% year on year in our retail outlets. We have also enabled RuPay transactions on our payment application HP Pay. In order to enable faster transactions and quick turnaround time, we are also enabling contactless RuPay cards facility in our entire network. We would like to congratulate NPCI for the launch of RuPay 2.0. The powerful new feature of offline payments will improve digital transactions in rural and low connectivity areas. The soft POS feature in RuPay 2.0 will improve last mile connectivity in digital transactions. And the contactless world will enable payments via wearable devices, which will make it much easier and convenient for enabling digital transactions. On behalf of HPCL, I wish to compliment NPCI team once again on the launch of RuPay 2.0 and wish them success in this endeavor.
We would now like to welcome Mr. Sandeep Makkar, Chief General Manager Retail Sales of Indian Oil Corporation Limited, to share a few words on how RuPay contactless cards are the preferred choice for Indian oil patrons.
Good morning. We believe that with great new features under RuPay 2.0, customers are set to witness an all new level of convenience in payments. With the advent of contactless features, consumers can witness a great sense of convenience and smart technology while making contactless transactions at Indian Oil petrol pumps. Additionally, RuPay is preferred partner of Indian Oil, and Indian Oil has rolled out co-branded debit and credit card having contactless features. Indian Oil Pay, which enables UPI payment through a common QR, has been witnessing surge in UPI and contactless transaction during this pandemic. Our best wishes to NPCI for launch of RuPay 2.0 platform. Thank you.
We would now like to welcome Mr. Karuna Karan, CFO of Shoppers Stop, to hear his thoughts on how contactless payments have changed the customer shopping experience in a retail environment.
Hi, you are aware that we are seeing a new normal. People prefer contactless payments not because of greater awareness on hygiene factors due to COVID, but also due to convenience. To make contactless payment accessible, the RBI has announced the Tap and Go functionality card payments for all purchases up to 5,000. This makes an ideal mode of payment for Shoppers Stop customers. We are very excited for RuPay contactless solution, which enables customers for faster billing instead of queuing up at checkout counters. RuPay cardholders can enjoy seamless, safe and hassle-free experience while shopping at Shoppers Stop. Thank you and enjoy shopping.
We would like to welcome Mr. Rajendra Kamath, CFO of Reliance Retail Value Formats, to speak about the impact of the pandemic on consumer preferences for in-store retail shopping.
This pandemic, customer safety is the prime concern for us, and we are making all the arrangements in our store for customer safety, like putting sanitizer in the store. Our store associates wear all type of protective clothing, so that we protect our customers from this pandemic. But when it comes to payment, customers is a bit apprehensive about using cash or touching the pin pads. Okay, so that is creating some problems. But at the right time, we came across contactless solutions offered by NPCI through RuPay cards, So it is implemented across all our stores. We are the first one to implement it across India in all our stores, and it is very easy and customers are very happy to use contactless payments for credit cards. So that is actually contactless. He is not supposed to touch the pin pad, so it's very safe for him. So customer is very happy about it. We are happy. Transaction speed is also good in that. And with the recent circular of RBI, where the limit is raised to 5,000 rupees for contactless payment, now we can cover all types of commodities and goods in our different formats like Reliance Digital, Reliance Smart, Reliance Trends, Reliance Fresh. So we are with NPCI and RuPay to ensure that this digital payment mode is rolled out across all the stores across India.
Digital payments have gone through a massive revolution, and to echo this, we invite Mr. Vishal Gondal, founder and CEO of Goki, to highlight how with innovative and groundbreaking technology, wearable digital payments will be the new accessory to enhance customer experience.
COVID-19 has accelerated innovation in a number of spaces. Healthcare, wellness, and especially digital payments have gone through a massive revolution. Today, I'm happy to announce that Goki has become the first wearable to partner with RuPay to bring contactless payment technology to 600 million Indians. RuPay is the pioneer in getting real technology in the hands of masses, and with Goki, you can now use your wearable device, all the whole range of Goki wearable devices, to use for payments across any POS terminal which supports RuPay. With wellness, health becoming the center point for everyone, we are seeing massive adoption of wearables for consumers. Everybody wants to track their heart rate, their oxygen level, their temperature, their blood pressure, and all these parameters. And they are now wearing Goki devices on their wrists 24/7. And now with this unique partnership with RuPay, all these people will be enabled to just use the same wrist to do a very, very safe contactless payments. And this is going to open a completely new frontier for people. So whether they want to pay their merchants in a restaurant or even use metros or any other things, this device along with RuPay will be their gateway to not only a good health but also a secure financial future. I really congratulate the NPCI and the RuPay team for such an amazing partnership. Thank you.
We would like to invite Mr. Subur Ahmed, VP Strategic Partners and Operations of TAPI Technologies, to share his thoughts on the new form factor contactless payment wearables and how this technology will pave the way to greatness in terms of digital payment dynamics.
TAPI Technologies is extremely proud to be collaborating with National Payment Corporation of India to launch contactless payment-enabled wearables in the market. NPCI is an organization which is at the forefront of innovation and technology in the payment landscape. With this collaboration, we are extremely confident that the deployment of payment-enabled wearables will really scale in the Indian market.
Let's see how RuPay Contactless works.
Vineet is a young professional who loves to live it up. He wants to be at all the places all the time and demands convenience on his terms. That is why he chooses the quick way, RuPay Transit. Your card can act as your ticket, helping you save time and the hassle of crowded queues when using RuPay Transit in a metro as well. When he is on the go, he loves to make at his own pace. That is why he saves time and effort by choosing to pay through RuPay Contactless. The best part is even when there is little or no connectivity, it isn't a hurdle to his speed. he manages to pay equally fast and keep moving smoothly. Loving the easy way is not particular to him alone. Those near and dear to him are equally smart. Today's life demands convenience with no compromise on style. Here you see them enjoying a hot cup and how they choose to pay through the wearable way with RuPay. When traveling or shopping, the most happening people will never be found wanting or waiting. They move with the time. This helps them avoid the hassle of queues or spending a long time waiting for their transactions. They choose to pay through RuPay POS. Home delivered essentials have an additional sense of ease now with RuPay POS being the preferred choice of acceptance. Even the merchants enjoy the smart way. No infrastructure costs, no bulky machines. A simple smartphone can do the trick. That is service with a smile for you. Here you see how hassle-free things are when the merchant uses RuPay POS. With so much happening, who has time to remember bill payments and keep a track of whether you have paid them or not? Be like Vineet. He likes his life and his bill payments easy and simple. He opts for recurring payments. RuPay AutoPay. He doesn't need to remember or worry about recurring bills anymore. The world is moving the contactless way. Have you tried it yet? Simple, easy, fast and convenient.
Well, we hope you enjoyed that session. The next session elaborates upon the idea of secure remote commerce, or SRC, as a globally interoperable network wallet solution. The talk will highlight how SRC will improve the checkout experience for users while improving e-commerce for merchants.
Good afternoon. It's a pleasure to be with you today. I'm Andrew Hopkins. I am the Global Head of Products for Discover Global Network. Today, I'd like to give you an update and perspective from Discover Global Network on secure remote commerce, SRC, as it's known in the consumer side, click to pay. I talk about the evolution of payments of in-person versus online. This is a global phenomenon and one that many of you are very familiar with. In-person payments have really become seamlessly integrated into the everyday life of consumers around the world. This is especially true during times of pandemic, when consumers are seeking other ways, cleaner ways, digital ways to conduct commerce, replacing physical points of sale. However, a lot of friction still exists in the e-commerce space. There's a lot of confusion on the parts of consumers, multiple options for merchants. The ecosystem is fragmented and cluttered. And so we have proposed and are launching a new feature in conjunction with our partners at EMVCo that aims to simplify that online checkout in a way that is globally interoperable, and then it incorporates a lot of the existing technologies that are already in use so that consumers and merchants can have a better e-commerce experience, a more secure e-commerce experience, and one that offers choice. I'll explain what the secure remote commerce is. At a high level, it's a globally interoperable network wallet solution. It's branded click to pay on the consumer side, and it's integrated into online checkout experiences. It's a simple single button functionality. And one of the main goals of this simplicity is to reduce shopping cart abandonment for merchants. It's a streamlined solution that allows for interoperability of specifications so that merchants can use one spec, and it consolidates the network brands into one solution, allowing for removal of clutter on merchant websites and mobile applications, and reducing customer confusion that research consistently shows decreases cart conversion. Through the pandemic, we've also learned that security is becoming ever more important. It's always been important, but now more than ever, making sure that new e-commerce solutions incorporate higher levels of security by using tokenization and other smart authentication features to ensure that consumers and merchants are able to take advantage of these. Let's talk about the click-to-pay symbol. The consumers are now learning is a symbol for simple, easy, convenient digital checkout. The SRC click-to-pay icon is easily recognizable and is becoming prevalent around the world. And consumers know that their payment information is stored in the click-to-pay wallet after enrollment for faster checkout. It's also stored in a way that is secure because much of the information remains in the wallet and is not distributed to the end merchant, thus reducing the burdens for both for merchants and the security risks for consumers. This is particularly important for small and medium-sized e-commerce merchants, especially ones where consumers may use these merchants infrequently. They may not have a stored card or a profile with that merchant. And so the click-to-pay functionality gives consumers the confidence to know that they can transact with a click-to-pay wallet and maintain their confidentiality and security. From a convenience standpoint, consumers also know that they don't need to continuously re-enter their contact information, their payment credentials, or shipping information every time. And this really helps consumers expedite checkout when they're on new sites or as a guest user. For small and medium-sized merchants, it's an ever-increasing challenge to maintain the security that's necessary to prevent fraud online. And so the use of advanced authentication methods in a federated way to verify the cardholder's identity increases the chances that we will be able to provide a positive affirmation of the consumer's identity. And it also ensures that the small and medium-sized merchants are able to take advantage of some of the most modern standards, which they often are not able to do. I'll speak to how SRC is integrated into multiple players in the complex ecosystem of payments. As we've spoken about, merchants get a single interoperable integration, a simplified checkout, and they will see this monetized in the form of lower cart abandonment. We are seeing increasing adoption in the US and indeed around the world, and are working with merchants in many countries to begin to adopt and deploy SRC. From an issuer side, SRC is an important e-commerce tool. It will help issuers protect their market share and allow them to deploy fraud detection and other approval and authorization technologies at scale to small and medium-sized merchants. For the payment service providers, or PSPs and aggregators, this technology will allow them to deploy SRC in a common integration across their merchants, thus reducing the custom work that is required. And for networks, it provides global interoperability. We partner every day with RuPay on interoperability around the world at Discover. And this SRC functionality will enable consumers on networks to transact at merchants across the world that have deployed secure remote commerce. Speak about what Discover Global Network has done. In the SRC space, we've invested in key digital capabilities to help our partners enable SRC. We're part of the interoperable global solution of the networks, and we're partnering with our colleagues in many countries to connect their networks to this technology. It's based on APIs, so it is very scalable using the most modern techniques. We're using digital capabilities to extend the web experience so that networks can control the UX, the user experience. Our tokenization functionality and cryptography has been deployed and upgraded to be able to deploy the tokens into this wallet and enable maximum flexibility. That the tokenization has also been delivered in ways that meet regional needs for data localization. which enables advanced authentication in marketplaces, gives issuers the option to do device authentication, any kind of one-time passcode or other additional authentication screens that they would wish to conduct. Reporting has been increased to be able to provide transaction analytics and web analytics so that issuers and merchants can optimize the shopping cart experience and the card member value. This has all been built at Discover to be ready to scale. There are lots of new and emerging use cases that the SRC technology can facilitate. It's interoperable to be able to connect to partners around the world, different players in the ecosystem, PSPs, merchants, and acquirers. And because it's been built entirely cloud-based, we can easily align it with local regulations and regional needs in each market. I'll take you through our global path. SRC is launched as Click to Pay. We launched with Click to Pay at the time that the other schemes went out with the specifications. We are now operating and enabling merchants in the US. Our international expansion has already begun, and we are speaking with many partners to be able to explore how SRC may be deployed in their markets. And we expect next year to begin to scale this into new partners, new markets, and new I think it's important to note here that SRC, because it is entirely focused on e-commerce, will become a global phenomenon, even if it is not necessarily deployed in every local market. Because it's deployed at a merchant level, merchants in a specific market can integrate it into their shopping carts, and consumers that are coming to their e-commerce websites, their digital stores, will see the SRC functionality and be able to take advantage of it, regardless of where that consumer may be sitting. So US consumers will see it on websites in the UK. Indian consumers would see it on websites in the UAE. So it is a global deployment that will likely be impacting every market, regardless of how quickly it's deployed at the merchants in the local markets. We're seeing increased adoption so far from payment service providers and merchants. Network tokenization is something that is expanding, but it's in different places globally. In the US market, where we first started, the token acceptance is fragmented. We have some merchants who are heavily using that technology and others who are not. And we need to make sure that we are maintaining a good payment experience, a consistent experience, and that the adoption of tokens. We do expect Indian consumers to be able to be coming across SRC, the Click to Pay functionality, starting next year, particularly if they are using websites at merchants overseas outside of India that would have deployed SRC. So it's important that we coordinate with all of our partners globally to create an experience that is ubiquitous, regardless of device. We're working with all of our partners to protect the market share of our common issuers and ensure that we have a globally interoperable solution with RuPay, as we've done with many other technologies. And as I mentioned earlier, there are always local and global rules that need to be complied with, and our functionality allows and enables this. And we're now beginning to work with partners around the world to understand what those requirements are, to meet local legal rules, and also enhance the customer experience in each specific marketplace. So thank you for the opportunity to present to you today. I can tell you that Discover is very much in the vanguard in the SRC space. We're beginning now to work with our partners globally, including our partners in India, to discuss this new technology and the way that it is best deployed and integrated with all of the technologies and players in each local ecosystem. I thank you for the partnership that you have with Discover and Discover Global Network through NPCI. I wish you that you will have a productive conference and that all of you and your families remain safe during this challenging time. And I look forward to the opportunity to meet with you again and discuss new ways to collaborate. Thank you.
The next speaker will give a strong insight into how JCB reevaluates their payment data to understand the consumption trend. Through their analysis and data customization, they aim to find the unique way to transform the payment data into business.
Hi, I'm Naohiro Takaku from JCB Mumbai office. JCB is a global payment network headquartered in Japan, and we are very successfully utilizing big data in Japan. So today I'll talk about how JCB is transforming payment data into business. First, let me talk a bit about JCB. One of our business fields is a global payment business. We license JCB brand to the financial institutions globally and facilitate the issuance of JCB cards as well as acquiring of JCB brands. In India, we tie up with NPCI since 2015, and as of today, there are about 7 issuers issuing RuPay JCB global cards. In Japan, on top of the license business, we do the direct issuing and acquiring business. We issue JCB cards to consumers directly, and we by ourselves acquire JCB merchants in Japan. And this is where we obtain massive amount of data. Since we do the business directly in Japan, we hold card member agreements and merchant agreements. And of course, our card members are constantly making transactions by their JCB cards at JCB merchants. In this cycle, we obtain massive amount of card member data, merchant data, and payment data. For example, age, gender, or residential area of card member, or the business categories or business size of merchants, and of course, all the details about transactions made by our card members. In the past, we used to utilize this data in a very limited way, such as marketing purpose for our own issuing business and also marketing support service to our merchants, in which we send out DM to the right segment of the card members on behalf of the merchants. But as the word big data has a keyword or the trend of society, we decided to expand the usage of our payment data. And what we did in the first place was that the re-evaluation of our data to find out what is the real value of it. First, we believe that the value of our data lies in its volume. We have massive amount of data, and we came to think that it is big enough to grasp not only the card payment world, but also the entire consumption trend of Japan. Second, its speed. It comes very fast. So basically, transactions are online. So we get the data the moment our card member make a transaction. And third point is comprehensiveness. JCB is the single acquirer of JCB brand in Japan, which means nobody else can acquire JCB merchants in Japan. So we have agreements with all the merchants in Japan. So wherever our card member make a transaction or whatever the merchant it is, we have the data of the merchants. This brings a great deal of comprehensiveness to our payment data because we pick up any payment data, and that data comes with the complete merchant information without an exception. With these characteristics, we came to realize that we can do a lot more than just utilizing it for marketing purpose, and this is where we came up with the concept of JCB Consumption Now. JCB Consumption Now is a whole new index of consumption trend for the entire Japan based on our payment data. We launched this service in 2017. And here's what we do in this service. First, we choose 1 million card members randomly and we anonymize the data. And based on the transaction data of those 1 million card members, totaling around 80 billion JPY or 57 billion INR, we come up with the consumption index for the entire Japan. And this is not only for the card payment consumption. This is the entire Japan's consumption index, including all modes of payment such as cash. And we provide this index as well as the detailed data via online on a membership basis. And this is where we make money out of it. And of course, our members can access to this database at any time, and they can very flexibly customize the data. And our targets include such as economists or analysts or central or local governments or marketing departments of any companies. And we are providing this service in a partnership with Nowcast. Nowcast is a leading company in Japan in the field of big data, especially alternative data, which comes from payment. We provide and manage payment data, and Nowcast processes it in a statistical way. And we believe this service is one of its kind in Japan, thanks to its outstanding strength. And those strengths lie in accuracy, speed, frequency, and variety. First, accuracy. So we're making the entire Japan's consumption index based on our card payment data. So the question you may have in your mind is that how accurate it would be. We are benchmarking Japan's one of the most reliable consumption index, which is Consumption Activity Index by Bank of Japan. And our index from JCB Consumption Now has been showing a high correlation with the index by Bank of Japan. So we believe that our index is a reflection of the true nature of Japanese consumption trend. And second, speed and frequency. JCB Consumption Now is the earliest way to get the consumption index in Japan. With classic type of consumption index, it usually comes after 1 month. So November's index, you get it sometime in January. And it might be the case that by the time you get this index, the situation of the economy may have been changed. And all you can do with this index is to know what has happened in the past. But with JCB Consumption Now, it comes in 15 days. So November's index, you get it sometime around 15th of December. So with JCB Consumption Now, you grasp the current status of the economy. And this is why we named the service as JCB Consumption Now. And third point is variety. Leveraging the huge range, wide range of our merchant data, we are providing not only the entire Japan's consumption index, but also the consumption index for the 39 business categories. For example, the entertainment is one of the categories that we provide the index for, but we further break it down to something like movie theater or amusement park. So JCB Consumption Now provides not only the entire Japan's consumption index, but also the detailed segment-wise consumption index, which is meeting the various needs and demands of our customers. So these strengths make our service one of its kind in Japan, and we believe that the JCB Consumption Now is the best way to know the consumption trend of Japan. And this is the reason why the service is widely appreciated in Japan. And these are some of the recent references to the service. So it's by Bank of Japan or Cabinet Office. Basically, Japanese government is referring to the service, and there were various media reports and articles. As the awareness to the big data increases, we feel that we're getting more popularity in the market. Now let's briefly turn our eyes to what we are actually providing through this service. This is the change of this year's total consumption index against 2018 and the number of new COVID infections in Japan. And I'm using the 2018 figure as a comparison because there was unusual consumption movement last year, 2019, due to the increase of consumption tax. So clearly in the COVID time, the consumption level goes down, and especially during the state of emergency where which was in April to May, basically government was asking people not to go out unless it is really necessary. And consumption level gradually recovering toward October. And JCB consumption now can add some more layers to this kind of data. The added two lines are category-wise consumption index. Green one is index for goods and black one is index for service. Clearly, service sector are being hit by COVID worse, while the goods sector is doing still okay because in Japan, most of the stay-home consumption, such as EC, belongs to this goods sector. Let's further go into the categories of the consumption. This is the change of consumption index for the categories, detailed categories of electronical appliances, furniture, and EC. So these sectors are doing even better in COVID time, and these are the so-called stay-home consumption. On the other hand, these added three lines are the category-wise consumption index for travel, food service, transportation. And as we all know, these sectors are hit very severely by COVID, so they are doing very bad in the last 6 months. But the travel is recovering toward October, and this is because of the government's stimulus policy to give out subsidy to consumers when they travel. Let's further dig into the data. This is the 2019's age-wise EC consumption, and it is a change against previous year. So basically, before COVID, EC consumption growth was happening mainly at younger generation, and while we are having some negative growth in the older generation. And so what happened to this? Is the same trend continuing or something else? Here's what happened. After COVID, EC consumption growth is happening across the age group. So even our grandparents are buying more stuff on EC. And digitalization of EC consumption is happening at older generation. And this could be a great insight for those people, for example, who try to come up with marketing plan for EC. And sometimes gender becomes a factor in having a different kind of consumption behavior. And this is the gender-wise consumption index for bars. And again, it's a change against the past years. Blue line is for male, red line is for female. And clearly, bar consumption level goes down because less people would go out for the drinking purpose. But here there's a slight difference between the genders. Female index dropped more than male's index. So there might be a trend that female are more reluctant to go out for the drinking purpose. On the other hand, this is the same index for liquor shops. Liquor shops index were doing better in the COVID time. This is because people tend to prefer buying alcohol at liquor shops and consume it at home. And here again, there's a slight difference between female and male, whereby female's figure increased more than male. So we could maybe able to say that a trend of switching from bars to liquor shop was stronger in female group. And this could be a slight difference between two different genders, but this kind of difference can tell us a lot about how a different segment of consumers would react to a certain situation, such as COVID. And these were the only few examples of what JCB consumption now can provide, and it has unlimited ways of utilization as per customers' need and necessities. So we think that the importance of big data utilization is increasing day by day, and the field has many opportunities for payment players especially. And to JCB, it was quite important to understand what is the real value of our data and how we can customize it so that we can meet the various needs and demands of the markets. I hope this presentation has given some insight to the topic. Thank you.
And the upcoming session will address common security-related questions about using contactless payment on commercially available off-the-shelf devices. The discussion will also delve into testing of various COTS devices and analyze their results.
Hello, and welcome to the presentation on the standards around COTS payments. I'll be talking particularly about the PCI standards for SPOC and CPOC that talk about the acceptance of customer PINs and customer card data on commercial off-the-shelf devices, or essentially mobile phones and tablets. Things have changed over time in the POS arena. We've moved from essentially PIN entry devices, a device that was literally just there for the purposes of accepting your PIN and perhaps accepting your card data as well. They were very simple. They had a small code base. They didn't support additional applications. They didn't really do a lot of things except accepting PINs and cards. We've changed over time to something that is quite different. Something that is large and complex. It has multi-application support. It has multiple protocols that it can support. It might have Wi-Fi or Ethernet or Bluetooth or any sorts of things. And it also has a very large operating system generally. It might be running Android or perhaps Linux, on top of which all of the payment functionality is built. And so this has led to an increase in the complexity of these payment systems, these payment devices over time, because customers are demanding more, the customers who use their cards, and the customers who use these products as merchants. And that's led to the next step in the evolution of these systems, which is taking the hardware away and leaving simply the application, the software that can be installed on a commercial off-the-shelf system to enable a POS acceptance device. So here we see what this might look like in a SPOC situation. So SPOC is software pin on COTS. So this is where you have the ability to take a traditional pin pad system and convert that, or implement that if you like, using a mobile phone with an application on it, a SCRP, which is a secure card reader pin, an external device that is used to accept the card, and a back-end monitoring and attestation system as well that is used to determine whether that solution that you're implementing is still secure, to deploy keys to that solution and so forth. The separation between the application on your COTS device and the card reader that accepts your card data is deliberate. That means that at no time is the card data and the PIN present within that one system in terms of the COTS system, the mobile phone, if you like. And that's to protect against fraud. Somebody might, for example, compromise the system, but all they'd get would be a 4-digit PIN that they wouldn't be able to correlate, to match up to any other particular card data. So it would be of little value. So in terms of CPOC then, what we have is a similar solution, but we no longer have that SCRP. We don't have that external approved PTS device that's being used to accept the card data. We're accepting the card data directly onto the COTS system. However, in this situation, what we don't have is the ability to accept PIN, at least in the current version of the standard. So we still have the back-end monitoring and attestation solution. We still have the application that sits on top of the payment system in terms of the COTS device here as an application. However, we don't have the ability to read physical contact EMV cards. It can only be contactless because that's the only interface that exists on these systems. We don't have the ability to accept the PIN. There is expected, and PCI have indicated that they will be making a change to merge these two standards, to bring them together so that we will have the ability to accept contactless cards and enter PINs on the one contactless device, on the one COTS device. That's probably expected sometime towards the end of next year, 2021. Not possible at the moment through PCI. It is possible through some of the independent card brands who have their own standards around this. But it's still very important that we maintain the security of that environment. We maintain the security of the application. And this is where some of the complexity comes into the assessment of these systems. So here we look at how we might scope an APK or an application, if you like, for example, on an Android system, because at the moment Android is the only system where you can independently deploy this sort of solution. And we can see that there is a lot of complexity. We might have applications that are not the payment application, illustrated here in the brown, that might be doing something suspicious, might be trying to read sensitive payment data, such as your card data or your PIN. They might be trying to interfere with the attestation process that's going on. You have the target application in the pink box that is then built up of general application code, security code, and payment code. We need to ask, is this developed with payment best practices in terms of your software development lifecycle? Does it have tamper detection implemented and obfuscation through additional software libraries and the process with which it's being built? Can it be easily lifted and removed and therefore attacked in a perhaps virtualized environment? What sort of permissions does it have? Does it have too many permissions, and that might lead to perhaps insecurities? Are there problems with the way that application is built up? How are the cryptographic keys built? All of these questions need to be asked, and many more, about that application. Where is the data being stored? How is the file system being implemented? What about the Android platform itself? How is that being used? Does it have the right level of security? What kind of APIs are being used? When you build an application, you might target a specific set of APIs that perhaps is older than the platform itself, and that carries with it some security issues. And then there's hardware features of the device that are relied upon by the application. Perhaps it relies on an Android key store. Perhaps it relies on a physical security chip that interfaces to the NFC. Do these things exist? How does the application check that they exist? These are all the things that we need to check. But it's not just about the application either. If we move on to the next slide, we can see that indeed it involves items in the back end as well. We talked about that attestation and monitoring solution. We need to understand as assessors, and the brands or PCI need to understand as approvers, how that works. What is it checking within that COTS environment, and how does it check that? Perhaps it is looking at a fleet of different devices. There might be perhaps 100,000 different phones that are being used, and some certain percentage of them are a particular type of phone. Are they all the same? Is there one that looks different from all of the others? And if it does, why is it different? Is that because somebody has just installed a brand new software update and they're the first person to have that? That's okay. Or maybe it's because they're trying to attack that application or that phone. This is what the attestation system needs to look for. It needs to look for these differences in the fielded systems. We also need to make sure how it's managing keeping itself updated. Obviously, mobile phones come out all the time. You have new operating systems coming out all the time. How does the attestation system keep on top of making sure it understands the new changes that are going on in these landscapes? Then the service provider themselves, how are they being maintained? Do they have a fraud monitoring system? Do they have the ability to interface through to the attestation system? How is that deployed? How are the staff being trained? How are the PINs handled at the back end? And how is the merchant being enrolled, for example? Or in fact, how is the merchant being decommissioned when the attestation system determines that their mobile phone, their COTS device, is too old, perhaps, or has some vulnerabilities? We can see that it's not all bad news, because mobile operating systems are in fact becoming more secure over time. They're implementing better security features, they're implementing better security management, and they're implementing not only at the operating system level, but with each new version at the hardware level as well, new features that really help to secure these platforms. And I'm very confident in saying that a brand new mobile phone that is fully patched is one of the most secure commercial systems that you can buy today on the market. They're really quite very good. So we don't necessarily need to be very concerned about the security in day one, but we do need to be concerned about the security over time. And we also do need to be concerned about the fact that mobile phones are generally built as personal use devices, not as devices that should or are used as commercial systems for accepting payments. And so the threat models are a little bit different as well. We can see that those threat models, in terms of the attack classes, there's unauthorized applications that might exist that might try to be modified or spoofed and so forth. Does the solution provider have full control over the applications? What about monitoring of communications? Is there some way that an attacker can do that through another application or with access to the platform? Now here is where, if you have modern cryptography being implemented, that really helps. But there's also platform modification. Can an attacker change the way the platform works by perhaps rooting it or jailbreaking it, installing their own operating system hooks to read the data as it's being processed before it's encrypted? You might have that really good cryptography in there, but if the attacker can read the pins as they're being entered into the keyboard, or perhaps read the card data through the NFC interface, then there's definitely a concern there. There's also challenges around obfuscation. Here is where it's a requirement that you package your application in a way so it's difficult to be reverse engineered. It has that tamper resistance features in the software. However, there is also a problem that the Play Store, in Apple's context, these stores are increasingly saying, we do not want you to heavily obfuscate your applications, because that creates problems for our malware checking, the store's malware checking. And so there's a bit of a friction between the increased security on the app side and the privacy controls that are being implemented at the store and operating system side. We can see that even more. These privacy controls that are being implemented in each and every version of operating system are really in somewhat at odds to the requirements for attestation, because they have station controls. You want to be able to uniquely identify a application, a phone. You want to be able to identify information about the other applications that are on that phone. But that's not very good from a privacy point of view. So there's a friction there that really needs to be at least resolved over time. On the next slide, we see that there are some operational challenges as well. With these systems, these mobile phones, they're not primarily designed for payments acceptance. And a payments device is very rigidly tested, very stringently tested around how much operating volume it has, how far it can read a card. We've done testings on cards with mobile devices, and those tests that we've found indicate on this next slide that they're not as good as a traditional POS device because they're not tested to the same standard. They're not designed for payments. Now, they're getting better, and there's some standards that are being developed that might involve making sure that these systems are better. But at the moment, certainly a mobile phone cards as well as your traditional POS system. The summary is that there's a lot of good things in COTS payments. Mobile operating systems are definitely getting more secure. We have better security features in the hardware as well. We have the ability to find ways to utilize those security controls so that the application vendors don't have to build as much themselves. The NFC readers are getting better as well. But the challenges are there as well. The increased sandboxing, the changes in the operating system around a privacy point of view are causing issues. There's certainly the risk that applications aren't able to do as much in terms of attestation and the back end. And in fact, it's more difficult to validate these systems, these phones independently. And there's a lot of operating systems features that are designed from a point of view of the user being in control of this device totally, as opposed to a merchant environment, that are a challenge as well. So I think with this thank you slide, I'll end here. But ultimately, I think there's a lot of really good things that are happening in COTS payments, but the challenges are there, and I would strongly recommend you think about how you're going to implement these solutions in the future. Thank you very much.
And this brings us to the final chapter of the ET India Inc. boardroom. In the next segment, NPCI is glad to announce the launch of Nth Partners Program, a common platform where all ecosystem partners come together to offer best-in-class services and form a one-stop shop to provide seamless integration of technology, infrastructure, support, and solutions for quick deployment.
Our nation is headed towards a smart digital future where millions of Indians have chosen the products of NPCI to transform their daily payments. This has only been possible thanks to all the partners on board who constantly enable our mission to expand financial inclusion across the country. From providing the technology for payments to fulfilling the final payment experience, there is a payment entity at every step of the way to a better, safer tomorrow. To acknowledge and celebrate these efforts and support of our partners, we are introducing a platform to showcase our partners who have been striving for our collective success. Presenting Nth Partners, an initiative undertaken to appreciate and showcase all the entities who have proven to play a vital role in driving the Digital India mission. The Nth Partners Program, where Nth indicates the infinite possibilities, brings together all the best players in the industry to facilitate and enable digital payments by providing customized solutions to banks, merchants, fintechs, and NBFCs. Today, NPCI has risen to be a technological powerhouse and the front runner in payment innovations. And with Nth Partners, the entities that are associated with NPCI get the recognition they deserve, like an NPCI certified trust mark for all new prospective partners willing to collaborate. In addition to this, associating with NPCI ensures numerous business advantages for you to implement and benefit from. Wish to become an Nth Partner? Join hands with NPCI for a digitally efficient India.
And before we end this year's edition, let's listen in to the closing address by Sanjeev Kumar, Business Head, The Economic Times Digital.
Good evening, ladies and gentlemen. What a year 2020 has been. Challenging would be a mild way to put it, but it has been a huge learning experience. Personally, I would say we have come out of it stronger, more resilient, and certainly more empathetic. This was also the overarching sentiment we saw at the ET India Inc. boardroom, India's largest corporate boardroom conclave. Let me take a few moments here to talk about Economic Times and why we thought about hosting the ET India Inc. boardroom. Over the last 7 decades, the Economic Times has been keeping track of developments, both big and small, in India's economic landscape. In all these years, it has gained the respect of business houses, CXOs, and investors alike for its reporting, and our readers look to us for our views and opinions. EconomicTimes.com, with its over 40 million unique visitors, is among the most widely read news portal in the world. With its strong storytelling capability and penetration among the business community, ET.com is uniquely positioned as an influencer and a guide. With ET India Inc. boardroom, we set out to create a platform where top leaders meet, discuss and ideate on the issues facing the Indian and global economy and solutions for the same. We are now 2 months into 2021, and while there are signs of economic revival, there is a long way to go for us as individuals, collectively, as a society, and for the economy. It has been my absolute pleasure to have front row seats to see the optimism that corporate India has and its belief in a quick and strong economic recovery. This, in a way, embodies the spirit and the ethos of EconomicTimes.com. We are strong believers in the Indian spirit of making it happen and ensuring growth and prosperity reaches all sections of the society. Over the last 5 days, over 60 eminent speakers, business leaders, economists, and policy makers spoke about how the Indian economy survived the pandemic, what we need to do going forward, the shifts in management and functioning we need to make, and what the future holds for us. One of the interesting themes I took away from the discussion was India versus Bharat. While this has been spoken about extensively over the last, say, couple of years or more, the conscious efforts towards localization are heartening. While this edition of the ET India Inc. boardroom has come to an end, I promise you this is just the beginning, and we will be back with another edition soon. And it will be just as big, if not bigger, than this one. I would like to personally thank all our speakers for taking the time to talk to us and share their insights. To them, I would like to say that you are an inspiration for a lot of us, and it was an absolute pleasure to listen to your views. I would also like to thank the team at ET for having put together this event, even as we grapple with the new normal of virtual meetings. In conclusion, I would like to say that I hope the worst is behind us, and now the only way for us is to move forward. And we do that with hope and optimism. Thank you.
And that, ladies and gentlemen, brings us to the end of the ET India Inc. boardroom for this year, brought to you in partnership with Transaction Next, powered by NPCI. You can rewatch any of the sessions of the ET India Inc. boardroom at etboardroom.com.